we had Charter Award ceremony today. So these are the name of the people who got their charter today. So anyone present here today who got the charter? Okay. So congratulations. So we'll start with next event, which will be spearheaded by Satyadeep Jain. So anyone who attended VIP, Value Investing Pioneer Summit? Okay. So in VIP, Ravi Dharamsi talked about mega trend, which is in energy sector. So this is related to that. And we keep hearing many few things about this mega trend, which is at the beginning stage. So we know most of the megatrend which are at their sunset stage. This is something which is at sunrise. So nice to have Satyadeep here. Satyadeep has more than 15 years of experience in financial markets and equities. He has worked across many cities and many organizations in New York, Mumbai, and New Delhi. He has more than 15 years of experience in metals, mining, cements, and utilities. He's working as lead analyst at Ambit. So without any further ado, please join me in welcoming Satyadeep Jain.
Hello. Hi, thank you, CFA Society for the introduction and for giving us the opportunity. As was mentioned, I work at Ambit Capital. I'm an equity analyst. I cover cement, metals, and power, all the old energy, all the old industrial sectors. Very briefly about Ambit, it is a full-service financial services firm. We do equity research, investment banking, asset management, our PMS, which was the coffee can portfolio, the private wealth, and NBFC. The head office is there in Bombay, but we do have presence here in Aero City, which is where I sit. So looking forward to interacting more with you and CFA Society. Here we'll be talking about power sector. There's no investment recommendation as such, but we just want to cover what has happened historically in the sector, what is happening, what are the trends, and how to look at how these earnings are playing out for the company and what are the trends that are going to shape these earnings for the next few years and decades. So we'll look at the entire value chain. So first is generation. It could be solar, it could be coal. Company generates power. That power needs to be transmitted longer distances by a transmission line, and there are players who will go and set up that transmission line. And finally, that voltage needs to be dropped to a substation, and where how do I go back? Pointer will be, or if I, okay. Okay, and how do I go back? Okay. And then after you transmit power, it becomes more like B2C. There's a distribution company that will sell that power to various customers. It can be industrial customer, it can be residential customer. There are players operating either in one part of the value chain, or there could be conglomerates in a way operating across the entire value chain. And we'll look at some of these companies also. But the entire sector, in a way, got revolutionized by Electricity Act 2003, when the generation was delicensed. It allows various players to come in and set generation without a license, and it could be captive power plant. And many players entered, including after 2003, Shah Rukh Khan also came and set up a hydropower plant in his village. It's called a micro hydropower plant, which was the theme of and which was basically telling you there was so much excitement and so many players started entering this space after 2003. When we look at power, when you look at supply demand also for power, right? The industry and the power planners are looking at two different ways to model power. and it's a very complicated exercise. But you have total power, which is the power demand across the entire year. It's counted in every single minute you're consuming power. So let's say as a country, we consumed 1800, 1900 billion units of power. But that power data is captured in every 15-minute time block. So we are capturing that much information, and we are modeling for, when we model also till 2032, we are, as a country, we are modeling power demand for every 15-minute block for the entire year for the next 10, 20 years. That's the kind of, the people who are modeling it, if you change any variable and to see is to stimulate, it can take you many days for model to change any single variable and to see the impact on the model. But basically what this is that you see the entire demand. Oh, thank you. So the demand is there throughout the year, but there are periods when demand is high and there are periods when demand is low. When the peak demand in our country typically takes place in summer monsoon, which is when you have humidity, you have higher requirement for irrigation, higher requirement for air conditioning, and typically winter, where we are right now, is more of a lean season. But within days also, there are periods when your demand is higher. Historically, that used to be in the evening when people come back from office, and also typically your peak demand was anywhere from 6 to 8 p.m. And during the night, that demand drops off. When you look at the entire demand, right, there is, you actually model the entire day or a year. This is entire year, let's say FY23, where the highest in one particular time block, the demand went to 220 gigawatt. And in let's say the lowest demand that we saw in the entire year was 100 odd gigawatt. And you had various data points across the entire year. As a country, what we are planning to solve for is called peak demand. Peak demand is a demand that you see 210 to, which was captured, let's say September 2023 at 12 p.m. for 15 minutes. When we are modeling and trying to see how much capacity we need, we are trying to make sure that we don't have any peak deficit. So we often hear the word peak demand, peak deficit. We are not trying to solve generally only the demand for the entire year. Do we have enough capacity to meet demand? We are trying to see if we have enough capacity to meet demand that happens in a peak period in any single year, in any single day. So this is like any power cycle is like any capital cycle. In the book, Capital Returns, the marathon asset management guys talk about capital cycle. It's actually capital that drives economic cycles more than anything else. When your demand is high, you put up capital to add capacity. There is typically a long gestation period for that capacity to come in. By the time that capacity comes in, your demand may or may not sustain, and then you have oversupply. When there is oversupply, your margins shrink, capital exits, then again that sows the seeds for again undersupply and prices shoot up, right? So that's typically any capital cycle, and power cycle is no different. Here we show what has happened in, as a metals analyst, what has also happened in iron ore, that you had periods in the 2006, 7, 8 period when demand was very high and supply was not that great, which is why you had high deficits and iron ore prices were high. And then, given the prices were high, a lot of capital was put to work. Given the long gestation period, all this new supply came in 2013, 14, 15, and by the time the Chinese super cycle had ended. So you had lower deficits, which led to a crash in iron ore prices. All the iron ore projects were, many CEOs who were running these companies were fired. New managing directors came with a mandate to not add any new capacity, to return capital to shareholders, which is why for many years we didn't have any supply addition in iron ore. And demand took off, and the deficits increased, and prices increased. That same thing has, in a way, happened in power. In the noughties, which is basically 2003 to 2010 era, you can see the supply was not growing as much as the demand was growing. Across the board, we had very high industrial demand, very high power demand, but your capacity growth was lagging demand, which is why you had peak deficits. The data we are capturing here is because we don't have that much historical data for the IEX prices, But MCP is basically the average price that you see for power on IEX. That is an annual price. Those prices are a function of how much peak deficit, right? This is peak deficit that we're talking about. So in the 2000 to 2010-11 odd period, we had very high peak deficits. And in the subsequent slides, we'll see historically, because we don't have data for prices for exchange, but we do have the data for how much deficits were there. But the entire deficit cycle kind of peaked in 2010-11. After that, a lot of new capacity already started coming because of the high prices that were there in 2007, 8, 9. Companies were adding capacity left, right, center. By the time this capacity came online, the demand did not sustain, and all the deficits started shrinking. When the deficit started shrinking, the power prices started shrinking. Come last 3-4 years, we've not been adding any capacity because as a country, if you look at the entire power cycle for the last majority of the last decade, we were contemplating, do we have an oversupply situation? Do we need to add capacity? And in that dilemma, the power demand started shooting up. Then, because of which your deficit started increasing. And again, exchange prices started increasing. And this is the main reason why you're seeing activity around power in the last 1 or 2 years, because your deficits are increasing and we need to add capacity. How much can these peak deficits rise or sustain is, obviously demand has slowed down this year, which has contained these peak deficits this year. But that's the fundamental theme any power analyst or any power investor is trying to figure out, that how much demand is going to be there and do we have enough capacity to meet that demand. So when you look at any valuation, it's nothing but two variables. No matter what way we slice and dice, EV to EBITDA, price to equity, price to book, there are only two variables that matter. It is A, reinvestment rate, and B, your incremental ROE. So this is just showing that these variables in an equation, but as analysts, when we're trying to model, we're trying to see only two things, right? Everything else doesn't matter. How much is the reinvestment opportunity and how much is the incremental ROE going to be? So when you are in an upcycle, typically you have peak deficits, so you need to add more capacity. Your reinvestment rate goes up. B, because you are in a deficit, you have pricing power, the ROE also improves, which is fundamentally why price to book will go up, because you're adding more capital at opportunities that generate higher return versus your cost of equity. Right? That is fundamentally why price to book will go up, because you keep accruing, there is accretion in a book value, and it is positive accretion because you're adding capacity at returns that generate higher returns versus your cost of equity. In a down cycle, the opposite happens. You are dealing with overcapacity, you're figuring out, do we need more capacity? There is an order backlog. There are more cancellations because we don't need so much capacity. So then the reinvestment rate comes down. Also, because you have oversupply, the ROE also starts shrinking. And that is when the price to book also starts shrinking. So you're trying to, in a way, trying to see where is the cyclical peak. When the cycle peaks, your everything will start coming down. So this is just showing what has happened just showing why peak deficit is important and why overall supply demand. You saw that entire last decade, the peak deficit was coming down and the ROE for the sector was coming down. And now the deficit in the last 2 years started going up, the ROE started going up. Same thing you can see the price to book for NTPC and peak deficit. When peak deficits peaked, the entire price to book peaked. That was 2009-10. When these peak deficits bottomed about 4 years ago, and they started picking up, your price to book started going up because everybody started thinking that we don't have enough capacity, we need to add 80 gigawatt, 90 gigawatt of coal capacity, your ROEs are improving because you need to add more capacity. Right? So this year deficits have come down because we didn't have so much demand. So everybody is now trying to figure out that how much demand is going to grow in the next few years, and then based on the capacities that we already see, is that going to be enough or not? So this is how the demand has grown over the last 30 odd years. The noughties and the 90s was a period of very high demand growth. we can't actually see the financial years, but you can see recently in the overall demand. So left hand is peak demand, the second one is peak overall demand. After COVID, we've seen that demand grow. This is rolling average, but grow at a very strong pace. In the last 3 years, generally, YOY have been growing at 10, 9, 10, 11%. So there are various drivers when you look at these mega trends and all, that what are the various drivers. One of the fundamental drivers is basically called electrification. So in the overall source of energy, there are various sources of energy, but you're replacing some of the other sources with electricity because you want to decarbonize. And electricity, if it is green, is helping you decarbonize versus other sources of energy. So one is obviously green hydrogen. If you use green hydrogen, you are decarbonizing certain industries. It can be in fertilizers with ammonia, it can be refineries, it can be steel, and many other. But obviously, we need green hydrogen to be economically viable. But it is going to consume a lot of power. Hydrogen is nothing but splitting water, and to split water, you need a lot of electricity. It's one of the most power-intensive industrial processes out there. Then you have other sources, data centers. The other one is, I'll talk briefly about it. So all these other trends which are generally believed to lead to higher demand versus what we've seen in the last 10, 15 years. One of the other variables, because when we look at data, when we are looking at power demand, this is the power demand injected into the grid. There are some players who are off grid. So let's say there is Ultratech Cement or there is Tata Steel, there are other players. They have set up, let's say Ultratech has set up a cement plant in Chhattisgarh. They already get coal for that Chhattisgarh cement kiln because you need coal as a fundamental part of the industrial process. They will also set up a captive power plant at the same site because they're already getting coal. This is what is historically, this was the fundamental reason why we had Electricity Act 2003. So companies can also set up captive, one of the reasons was companies can also set up captive power plants. Once you set up a captive power plant, you don't need the other power sector, right? You're setting it up yourself. You don't need transmission. The power is generated right there, consumed right there. You're generating it yourself. You don't need power. Now what is happening is, given solar and wind, and everybody wants to decarbonize, your source of power is not in Chhattisgarh or in your, where you're producing the main output. It is in Rajasthan or Gujarat or other states where you have solar and wind. So some of these companies don't want to go and operate these power plants in other locations, which is why this entire opportunity has opened up for the power developers or the power sector in general. So since the location of power generation is far away from the consumption, you also need transmission. Earlier, you didn't need transmission for these players. And since you don't want to go and set it up in these states, you rely on developers to go set it up. So this is also one area, given the entire decarbonization focus, which has led to higher demand of power for the entire sector. So these are the peak deficits that I was talking about, the base deficits. Generally, the challenge with when we talk about solar and wind, one of the biggest challenges is actually peak demand, not overall demand in the year, because we're already, as countries put up more solar, you're already generating so much power during the day. The challenge becomes meeting power when sun is not there, and which is why peak demand is what everybody is trying to model, which is also non-solar peak. So you break down peak solar demand into two different time slots. One is the demand that happens during solar hours, and the other one is that happens during non-solar hours. And that is the most important thing we're all trying to figure out. And this shows you peak deficits that they peaked in 2009, 10. When they peaked, they started shrinking. And now again, they started going up. So one of the reasons why we've seen this entire greening, solar, wind, and all is driven by, and we'll talk about it in batteries also. In batteries, when we look at batteries, we're going to talk about the entire value chain, what has happened globally over the last many years and decades, and the process and the entire value chain, and who are the players, and how can economics work out in there. But fundamental is, when you read the book Chip Wars, they talk about the Moore's law. Moore's law is basically doubling the number of transistors on a chip. Moore said given the technology improvement, the number of transistors you have on a chip will keep doubling each year, which is why everything has got cheaper over time. Semiconductors, anything you look at to do with electronics. And solar module is no different, and so is batteries. Solar module prices have declined over time because the process has got so much more efficient over time. And you can see lower module prices have also led to lower solar generation prices. The power that we generate right now, when you look at tenders and all, the solar generation cost is 2.5 rupees per unit. Back 10 years ago, that number was 15, 16 rupees per unit. Even before that, it was not even viable before that. So this is the evolution of module prices and battery prices over time. Solar module prices that all of us see, all these companies, Wari, Premier, and all these different companies, back in the day, it used to be $80 per kilowatt. Right now, it is 10 cents per kilowatt that China is selling it. It's 99.9% reduction in solar module prices in the last 40, 50 years. Similar thing is playing out in batteries over the past many years is because technology is improving every single day. On the other hand, when you look at coal plants over time, it used to cost 4 crore per megawatt to set up a thermal plant 10, 15 years ago. Now it costs 12 crore per megawatt to set up a new coal power plant. So the economics are working in opposite direction for both solar and renewable in general, but largely solar and thermal coal, which is one of the reasons the source of power, you're seeing greater share of renewable energy in the entire mix for anywhere. This is largely globally, but in India also you're seeing similar trends. So what this does is it creates a massive reinvestment opportunity for the developers. Once you set up a thermal coal power plant, let's say NTPC sets up a thermal coal power plant, you will be putting in capital 4 crore per megawatt, as I mentioned historically. On that you recover your ROE. So historically, all these thermal coal power plants are regulated ROE model. You generate a fixed ROE. So whatever capital you put in, you look at the equity contribution 30%, and on that you generate that 15.5% ROE. Then Coal India comes in, and they also put capital for developing the mine, and they supply coal, right? So when an NTPC power plant is selling coal power, it has two combinations. One is the fixed cost, which NTPC is recovering. The other one is variable cost, which is in a way raw material cost for coal. So the coal thermal power plant is capturing only half of the pie. The other half is being captured by the Coal India, somebody who's supplying the raw material. In renewable, there is no raw material. It's all, solar and wind are all free. It's all fixed cost. You go and set up a solar power plant, the tariff you charge is based on recovery of the fixed cost for that power plant. There's no concept of variable cost. And let's say we set up 4 crore per megawatt thermal historically. Now that's over time gone up. Renewable is coming in at 5 crore per megawatt, but it only, to meet 1 gigawatt of demand, historically, we would have set up 1 gigawatt of thermal, let's say. To meet the same demand, we need to set up 3 to 4 gigawatt of renewable energy because it's only the utilization level of the PLF is low. So that means to meet the same demand, we need about 20 crore of capex, right, in megawatt terms. That creates a massive reinvestment opportunity. That is why the capex that we're seeing for the sector across the board and largely driven by renewable is going in another league compared to what we've seen in the past. It's because there is no concept of variable cost. It is all fixed cost. It is all capex. It's a massive capex cycle. This is generally looking at the solar radiation map. India, we have decent solar radiation. Obviously, some other countries have higher, better radiation than what we have. But if you look at the overall PLF of solar power plants in India, and you look at wind, solar is generally where we are better than average when we look at the PLF that we're generating on solar. On wind is where there has been a challenge, partly we can call maybe planning. We don't really have as much wind as some of the other countries have. And also, it was set up using older technology. Now you're setting up wind power plants using better wind, better technologies. But the challenge is some of the best windy sites in the country are now gone. This is, and now this presents another challenge when we look at modeling. This is a typical solar generation curve, right? So if you have a 100 megawatt of solar plant, it will give you 70, 80 megawatt at the peak in the afternoon. And then it will drop to zero by 6 p.m. And same thing in the morning, it starts generating at 7 a.m. or something. During the non-solar hours, there's no solar generation. So you need to count on other sources of generation. The wind is slightly complementary. When solar is not there, wind comes, which is why you have something called solar-wind hybrid. You combine different sources that complement solar to flatten that curve somewhat. So as to meet the non-solar peak demand, which is the demand that comes in after solar steps down. And there are various sources that the country is relying on to meet that demand. One is, we'll talk about those in the future, in the subsequent slides. So this is called a duck curve. You can see the black one looks like a duck. Basically, what this shows is that during the day, you have solar generation, right? So you don't, the other sources of generation need to step down. If you're generating thermal, that thermal generation plant will have to lower the generation during the day when you have so much solar. When you don't have solar in the evening, that is when other sources need to be stepped up. This is one of the fundamental challenges when you have so much solar in the grid. Over time, and I'll show this in the next slide, this is going to get deeper and deeper. This is called duck curve. In California, this is now becoming like a valley, where it becomes like a steep valley. The challenge is if you have a thermal power plant, there is a ramp rate, there is backing down. You can't just suddenly shut down thermal power plant and then ramp it up in the evening. But largely what we have for the last 1 or 2 years trying to solve a problem is that you have solar during the day, but how do you meet the demand in the evening? So you need thermal. All this solar and wind is good, but you ultimately need something to meet your peak demand. That was for the last 1 or 2 years thought of as coal is there and then wind, which is why the entire activity around wind in the last 2 years, because to complement solar, you need something to meet that demand. And then you had thermal. But suddenly the battery prices have just been on a nosedive in the last 1 or 2 years. And now you're looking at battery as one of the more viable solutions as well. So they are all competing for that, the source that's going to meet that non-solar peak demand. So this is how California demand curve looks like. So during the day, this is a region which is far ahead of anybody right now. So this is just a possibility, a look into how future can shape up for other countries, because they have gone to another different league in terms of this entire green transition. And we'll see it presents challenges also if you go entirely green and don't rely on thermal. How do you are solving for energy transition, but you need energy security. So that entire energy transition versus energy security in the entire planning to meet energy transition, do we fall short of sources, which is why you had some shortages in Europe and other countries, because everybody was going green, but there is nothing to meet that non-solar peak demand. But the battery prices, as I mentioned, the way they've fallen, it is creating something interesting for the entire grid, and which is why you have so many new tenders which are coming up, which have battery as a key component. But this is showing you that during the, let's say during the day, you have so much solar that is being generated, that solar power is being used to charge the batteries. So there is so much excess solar that you're generating that if you don't use that solar generation, you have to flare, you basically have to cut it from the grid. You're generating power, but you can't use it, because without batteries, you cannot store power. It's a commodity that cannot be stored unless you have battery. So now you're seeing during the day, you're generating so much solar that some of the excess you're using to charge the batteries, and in the evening, you are discharging the batteries. So to meet that non-solar peak, you're using batteries to meet that demand. And in the morning and all, there is some still gas which is coming up. But to be able to keep doing this, you can imagine if you need to meet more non-solar demand, you need to add even more solar to be able to charge the batteries. So that is obviously going to have some implications on how much solar can we add. This is something that possibly could happen in India, right? If you look at 2040, this is looking, I think the legend got cut, but the bottom one is basically 2040, given the way the tenders are shaping up for renewable energy, we may reach a situation in 2040 where we have excess solar generation, that we don't need so much solar, because and everything else needs to be shut. Right? If solar is able to meet your entire demand, and even that is more than excess to meet your demand, the other sources will have to be switched off. Then obviously you have the gray line above that is battery. That battery comes up and flattens that curve somewhat. So it uses some of the excess generation during the evening, during the day, and also uses the excess generation to meet the non-peak demand. But as I mentioned, battery versus wind versus thermal. There are three different sources. Solar is obviously there during the day. For non-peak, these are the three which are competing with each other. And which is why, if you look at all the tenders, right, SECI and all these agencies come up with tenders for renewable energy. Historically, it was largely solar, wind, and all. Now the tenders that you see, solar itself is very small right now. Now the grid also wants some kind of complex where you not only have solar, you're adding batteries, you're adding wind, you're adding other sources. These are called complex tenders. There are various terms to be able to meet demand not during the day itself, but also during the evening. Because any grid knows that they can rely on solar from anywhere in the country. There are many developers, you can keep on adding solar modules. The challenge is meeting that non-solar demand, and which is why these tenders, when SECI is coming up and saying, I need 10 gigawatt of this, I need 5 gigawatt of this, 1 gigawatt, and companies have to come and bid for these tenders. These are now becoming increasingly more complex, where SECI is saying, the DISCOM is asking SECI in a way that we want tenders which have a component of wind, battery, and which help us in meeting some of the extent. They also mention the extent of demand that needs to be met by these sources in the non-solar, in the evening demand tenders. So all these players that you see, whether it is NTPC Green or Tata Power, or all these companies, when they talk about renewable, it is a combination, or Acme Solar, it's a combination of many different things that are going on now. It's not plainly only solar, only wind. And that is also the entire, when we look at earnings, how to model this, this has also fundamentally changed over time. Historically, it was all regulated equity. You put up capital, you put up 5 crore of per megawatt of thermal. By regulation, equity had to be 30%, still has to be 30% of whatever capex you put in. And that 1.5 crore you generate, that is your equity, that becomes regulated equity. On that, you generate 15.5% ROE. So that becomes your PAT. In power and regulated model, the P&L works bottom up. So it's not like you're trying to figure out revenue and then come down to cost and go PAT. You start with PAT and then you go back up, because PAT is given by the regulator. And then you keep on adding fixed cost, variable cost, and then on basis of that, you determine the tariff. Now in competitive models, because solar and now increasingly transmission also, it is competitive. The agency says, I want this much gigawatt of renewable energy. You come and bid the price. Whoever bids the lowest price wins the tender. There is no regulation. You can have as much debt, as much equity, as the way you model. So the typical P&L, an FCF for regulated would look like this, where your PAT is defined, your depreciation is defined, your debt repayment has to be equal to depreciation. Right? So whatever depreciation is there, your debt repayment has to be equal to that. So your FCFE, which is PAT plus depreciation my debt repayment, is fundamentally equal to PAT. So if you're generating 16, 17% PAT, you're generating 16, 17% FCFE. It's purely simple. Now it's entirely different for renewable. You can go and structure it any way you like. You can have 80%, 70, 60% debt, whichever debt you want. You can repay it whenever you want, based on how the lenders are comfortable. Right? You need to meet debt service coverage ratios and all, but you don't have to repay debt which is equal to depreciation. So typically, in this one, the way they structure, initially as PAT is almost negligible, non-existent or minimal, but you're still generating FCF, because there is no debt repayment in the initial years, but you have depreciation. You are generating high FCF, but your PAT is not there. So the earnings model looks very different. So for a regulated model, you have the same FCFE and PAT for the entire 25 years. In this one, in renewable, it's the exact opposite. Initially, you don't have PAT, but once you repay debt over time, your PAT increases. Initially, you build free cash flows to repay the debt, and eventually you start repaying the debt. So initially cash flows are higher, and then they go down, but initial PAT is low, and PAT goes up over time, which is why when you look at renewable, people have found it difficult to value it based on price to earnings and all, because there is no PAT in the initial years, which is why the entire power sector has in a way evolved to EV to EBITDA. But ultimately for us, what matters is whether you look at EV to EBITDA or price to earnings. Ultimately, cash is king, so you're trying to value FCFE. But generally in all the comps and all, now you don't see any mention of price to equity, which was historically the case. It's all largely EV to EBITDA. And given it's all, in a way, a leverage buyout model. So to be able to maximize IRR, you're competing for, in SECI tenders, you're competing for 1 paisa. The difference between winner and loser is 1 paisa typically. So you have people bidding at 2.6 rupees per unit for solar. Somebody comes and bids at 2.59. He is going to be the winner. That is the extent of difference in one L1, which is the biggest, which is the lowest in the next one. You're trying to see the biggest differentiator is typically your interest cost, because debt is 70-80% of overall capex, and you can delay the debt repayment. It becomes more like a leverage buyout model. And anybody who has interest cost advantage has an advantage in IRR, right? So if your interest cost is lower, your IRR is going to be higher, which is why some of these state-owned entities with lower interest cost, whether it is NTPC or PGCIL in these competitive tenders, they have an edge as far as interest cost is concerned. Because their interest cost would be 7.5% for others, private players. It may be, for conglomerates, it may be as low as 8%. For others, it may be as high as 8.5%, 9%. So you're trying to, if you're others and you want to compete with these, you have to try and out-compete on others. It could be EPC, better sourcing and all, but difficult. This is the biggest mover typically in these competitive tenders, the interest cost that you have. Now, one of the other challenges of this entire story is the entire coal plants that you have in the country the entire coal mines are largely in east, in Chhattisgarh, in Odisha, Korba, all these different locations. This is, they will go and set up coal power plants and supply to other states. Now, when you look at the entire energy transition, all the solar, and you can see it, the darker it is showing you that is where most solar radiation is. It's all on the west and south. There is little solar radiation on the east, which is why all the renewable generation is actually coming on the west and east coast. And that presents a challenge for some of the eastern states, that they were relying on coal as a massive source of revenue historically. But now when you look at the transition, they don't seem to have that big a role to play in the entire generation. So that is, and because coal is also a massive source of revenue and employment for these states, that is also something the planning bodies are working on to make sure this entire transition is not too punitive for the eastern states. So you can see, as a country, we have renewable power obligations that all states by law have to meet X percentage of their power from renewable sources. All the states, you can see typically south, west, are largely meeting these obligations. The ones that are falling short are the eastern states. And you can see the reason why. They're largely coal, they don't have enough, they're not able to compete on solar and wind. And that will we talk about transmission, also going to have some implications. So when you look at the transmission, typically historically, let's say we had coal power plants. We're sitting here in Delhi, Dadri power plants and all. Usually, or let's say you're meeting demand in Rajasthan. What will typically happen is Coal India will go and set up coal mine, has already operating coal mines in, as I mentioned, Korba, Chhattisgarh, Odisha. They will not typically, companies may not go and set up power plants there. Coal will be transported by truck to, let's say, Dadri or to other stations, and then the power will be generated there and then transmitted to the generation station. So the entire distance from coal to coal generation to the actual consumption of electricity was bifurcated. Part of the share was taken by coal trucking and partly by transmission. So you needed only 100, 200 kilometer of transmission line. But I'll come to that. But before that, sorry, when you look at transmission, it is a combination of interstate. We look at ISTS is called interstate, and the other one is intrastate. Interstate is like a national highway, which is connecting many states, which is where power grid would typically function. this will be setting power, let's say if you are Karnataka or Rajasthan, and you need transmission to connect to another incoming state where the power is going to be consumed. You take power there as a transmitting line. Once you reach there, you rely on a state highway to be able to get to the end customer. So the entire transmission is split between like a national highway and a state highway, interstate transmission system, ISTS, and also intrastate. So as I was saying, historically what used to happen was the coal will be trucked and then coal power generation and the end customer. The entire distance or the profit pool is split between truckers and the transmission company. With renewable, that's not the case. As I mentioned, there is no renewable generation, which is what is leading to longer distance transmission lines. So if your customer is 600, 700 kilometers away, you need longer distance transmission line. And typically the voltage drops over longer distance, so you need substations, which is why you have something called HVDC coming up. To be able to meet longer distance, you need HVDC, which is much higher capex versus. So when you look at transmission, like globally, we are hearing of shortages of transmission, transformer, grid. One of the fundamental reasons is when you look at thermal, if you had 1 gigawatt of thermal of demand and you were meeting it from thermal, you needed 1 gigawatt of thermal capacity that needed to be evacuated. The rule of thumb for transmission in the country has been for a national highway that I talk about. When I talk about generating capex generation, you need about 4 crore, 5 crore per megawatt of thermal capacity. Now that's gone to 10, 12, 13 crore. For solar, that number is about 4, 5 crore. For wind, that is 8 crore per megawatt of generation. The same rule of thumb for evacuating power for transmission, right? So once you generate power, you need to evacuate that power by transmission. The same rule of thumb for when you look at the entire transmission I mentioned, like a national highway and state highway, the same rule of thumb for national highway is 1 crore per megawatt for thermal when you're carrying power over 200, 300 kilometers. The intrastate will be 50, 60 line, but let's keep out intrastate here for a bit. So let's say you had 1 gigawatt of demand and you set up 1 gigawatt of thermal capacity. Your rule of thumb is 1 crore per megawatt. So your capex on transmission is 1,000 crore, right? Now RE comes in. To be able to meet that same 1 gigawatt of demand, you set up 3 gigawatt of generation capacity or 4 gigawatt. And you're transmitting that power over longer distances. So HVDC line that I'm talking about 1 crore is 4 crore per megawatt. So there is going to be some component of HVDC, some component of AC. So overall capex that we're looking at 1 crore is now becoming 1.5, 2 crore per megawatt on a weighted average basis. So you're setting up 3 gigawatt for meeting the same 1 gigawatt of demand, 3 gigawatt of generation, and let's say 1.5, 2 crore per megawatt of transmission capacity. The same number that we saw, 1,000 crore, is now becoming 6,000 crore. That is fundamentally, when you look at transmission, is nothing but a proxy on renewable energy. The more renewable energy that you're seeing more transmission, and which is what is creating the challenge. When all these developers talk about, we are adding so much capacity, this is a plan, we're going to add 5 gigawatt, 10 gigawatt, reach 60 gigawatt. The fundamental challenge to that is, do we have enough transmission or not? So we, as analysts, are trying to see that whatever targets we have as a nation, do we have enough transmission? And which is one of the biggest challenges in US also. And which is why you're seeing all this entire transmission activity really take off in the last 2 years. Massive increase in transmission bidding. Because, as I mentioned, the transmission opportunity size, once you have reinvestment that goes up, you're fundamentally dealing with undersupply, shortage. Your ROEs are also going up. So the revenue by gross block, it becomes a proxy for when you bid for a transmission project, the government gives you the capex estimate for putting up the transmission line, and the bidder goes and bids for an annual revenue for 35 years. Whoever bids the lowest revenue on that gross block wins the project. So we look at revenue by gross block as a proxy for equity IRR. That number has fundamentally improved in the last 1 year because, as I mentioned, the cycle has turned in favor. You have massive reinvestment, massive increase in ROE. There is obviously going to be challenges to this. I think the risk is, as a country, we have something called ISTS waivers. When I talk about ISTS transmission cost, right? 1 crore per megawatt or all this 2 crore. When you're setting up renewable energy, the country has given ISTS waivers. What happens is the planning body collects transmission charges from various states, and that is not based on how much you're consuming. It's like going to a dinner party, no matter how much anybody consumes, at the end of the dinner, everybody splits it equally, right? So what typically happens in the socialization is the people end up consuming more. They don't care about the overall bill because they think it's going to be socialized. Come next year onwards, in FY25, this socialization is going to stop in a staggered manner. 25%, 25%, 25%, which means you have to pay for what you consume, which typically what is happening in the last 2-3 years is everybody wants to go and set up renewable in Rajasthan and Gujarat because the radiation is the highest, your cost of generation is the lowest, and you don't care about transmission because ultimately everybody pays the same. Now, if you buy from Rajasthan, you have to pay the transmission cost yourself. So now the challenge that planners will have in the next 2-3 years is, do we go and set up renewable in Madhya Pradesh instead of 2.5 rupees per unit, generation cost is 3, but maybe transmission cost is lower. So the entire delivered, right now people are focusing only on the generation cost, right? Delivered cost doesn't matter. Next year onwards, people start focusing on delivered cost. And that is when we have to see how this transmission story also evolves. But that may also present opportunities for other states to, right now nobody's focusing on some of the other states outside of Rajasthan and Gujarat. So when you look at, so that was transmission. When you look at distribution as the last leg, this has been the pain point. But distribution can also be, let's say when you look at torrent power and some other examples, there is distribution licensee and a distribution franchise. There's a licensing arrangement where you get a license in a particular geography. It could be Ahmedabad, Surat, you have Delhi also, multiple licenses in Delhi. Between different regions of Delhi, you have BSES and Tata Power, and same thing you have in other states, right? So you have a license who puts up capital to put up the entire substation, distribution, transmission network and all, and they get a regulated return. This is a regulated return model. You put up 100 crore of equity, you'll get 15.5%. The ROE is determined by various state regulators. The other one becomes more like a B2C, where somebody has put in capital and somebody else comes in and says, I can take franchise of your, you've already put up capital, I will go and sell power in your name. My only job is to reduce the billing and collection losses in the system, because we are selling, the DISCOM is selling 100 units, but at the end of the day, it's only recovering 85 units. There is some which they're not able to bill because of various reasons. There are some that they're not able to collect because of various reasons. So you're billing, you're selling or you're buying 100 units from the generators, but you're only collecting 80, 85 units. So the franchisee comes in and says, I can help you collect, maybe improve these billing and collection losses. And for that, compared to the targeted trajectory that they have for reducing billing and collection losses, if they fare better, then they get incentivized. So that's a billing, that's a DISCOM franchise model. And then you have distribution license. So in India, there are various places where you have distribution licensee, which have opened up privatization. So there are various places where you've seen Ahmedabad, Surat, Delhi, Bombay, some union territories. Other states, it's ultimately, when you look at the entire constitution of India, there are 3 powers vested. One is union, union, state, and concurrent. Concurrent is where both states and center have a power. And that is, power is a sector where we have concurrent list. And it becomes fundamentally more politically contentious when we look at privatization. But when you look at companies, you'll see both. Some companies may be participating as franchisee, some as licensee, or some on both. But this has been a pain point over time. Your losses, DISCOM borrowings have increased over time. But generally, we've seen some regulatory initiatives because of which the gap between what you're billing to the customer and the cost you're incurring has shrunk over time, because the regulators are penalizing DISCOMs in a way for not recovering enough of your cost from the customers. But this has been a pain point there is some improvement. We need to see how far we go on there. Smart meter is one of the opportunities, because you have prepaid meters. They help in reducing the billing and collection losses to some extent, because it works like a prepaid mobile card. We've seen a significant pickup in smart meters in the last few years. When we look at smart meters, historically, we saw smart meter as only an opportunity for reducing billing and collection losses, but I think a lot of people underestimated the role. It's all smart meter is nothing but data. You're trying to collect as much data as possible, and that helps in trying to figure out. You can't do solar rooftop, let's say net metering, without smart meters. You can't do EV charging because you need to see where there's going to be more demand for EV charging versus others. So as a discom, when you plan the entire EV charging network, you need to be aware of data. So there are various reasons where, and when you have complex tenders, right? I'm saying we need to model for next 10 years, each and every time block, and see, discom is trying to see how much power it needs in a certain time block from different sources. Right? So does it have enough, has it procured enough thermal, has it procured enough coal to meet maybe demand, or solar or wind to meet demand in every time block for the next 10, 15 years. And for that, you need a lot of data. Right? You can't do that without data. So this has emerged as an opportunity, not just for reducing billing and collection losses, but for giving you more granular insights on that data. But obviously, political hotball, this is getting challenges in multiple states because of political reasons. When you look at various companies also, over time, this is the profit pool of the PAT mix for various companies 5 years ago. When you're seeing most of the capex that companies are doing, right? Any company you look at where they're operating in multiple segments, the incremental capital employed mix is shifting increasingly to renewable because nobody is really putting capital to work for thermal except NTPC, which is putting some to, but the massive reinvestment that is happening in renewable, which means the more capex and profit mix is evolving for companies, and you're seeing greater share of renewable energy in this. When you look at, this is typical for any cyclical company looking at cycles. When you have a situation where, let's say your intersection is zero, your demand and supply is meeting, when that demand moves to the right, then you need more marginal cost players to meet that demand, right? That's when you need more coastal power plants. The high cost players in the country are coastal power plants, gas plants and all, because the incremental cost of generation, when you look at the entire cost curve or merit order dispatch, you can see typically at the lower end will be NTPC thermal coal plants and all, because they are typically pit head, close to the pit mine and all. Increasingly, you go towards the upper end, will be the power plants you have on the coast, which will be relying on imported coal. And then you go to gas, because as a country, we set up gas power plants in the country back in the day thinking we'll have gas, but the potential that we saw in KG Basin and all didn't materialize. So we don't really have enough gas in the country. All the gas plants that we set are relying on imported energy, majority of them. And the gas, the production cost is the highest for a gas power plant. But typically, when you have a cycle, it is analysts, when we're trying to see, is the cycle bottomed or peaked out? Let's say the cycle has bottomed and we are sitting at zero, and suddenly you have shortage and the demand moves to the right, and you need more costly, because you have higher deficits, you need more costly plants to meet that power demand, right? That is when you'll see the incremental plants which are not generating profit, which would be coastal plants, gas. So let's say Torrent gas plants, Torrent Power, and you had coastal plants, some in Tata Power, some other plants. These are largely, and some merchant power plants. Merchant would be typically in this country, majority of the merchant are by default now the higher cost plants. They become profitable, right? So the biggest earnings delta when you see a cyclical bottom will come in plants or in companies where this operating leverage kicks in. And when the cycle peaks, the reverse will happen. The curve we are seeing will shift left, and the entire supply that you needed from high cost plants will not be required, and suddenly they will become unviable. And so one of the things you're trying to see in a cyclical is who has operating leverage, who has not. This is generally showing that EV to EBITDA, when you look at EV to EBITDA and valuation for different companies, largely the companies that are generally commanding higher valuation are the ones which are typically exhibiting higher EBITDA growth. And the EBITDA growth is generally coming from renewables because the massive reinvestment rate that you're seeing right there. That's it. I think I had one slide, maybe I missed it, but I was generally showing that when you look at the entire capacity mix for US, it was maybe 30, 40% coal, gas, and solar. But the new capacity that you see in pipeline, which is based on transmission requests, it is all solar, battery, storage, wind. So it is also giving you an idea of how this entire capacity mix is shifting. And for India also, when we look at the capacity mix in 2030, 35, it's going to evolve compared to what we had in FY 23, 24, the greater share of renewable in the entire mix. I think that's the end of this one. Obviously, we have battery after this. Any questions?
Any questions? Any questions? Please raise your hand. We will come to you.
Thanks for this wonderful presentation. So I would like to know which companies in India which are focusing on transmission part, means which are key players who are working on transmission auctions and means as you're saying this is one. And what are you say economics there and valuation at the transmission side?
When you look at transmission, as I mentioned, there are two different opportunity sizes. One is the ISTS, and the other one is intrastate. There are two different opportunities. When you look at ISTS like a national highway, historically, majority of it used to be on a regulated model. That on a nomination basis, you go and the regulator will award, the government will award you, and you get fixed ROE of, historically it was 15.5%. It was reduced to 15% in 24 tariff order that came in. So you, whatever capex you put in, you get 30% of that has to be equity, and 15% now is the part you get on regulated. But now incrementally, the entire country, not just in power, because I cover mining also and all, is moving to competitive bidding. You don't want nomination, allocation, which becomes more of arbitrary. So 90, if you look at PGCIL, Power Grid, which is a proxy, 90% of what it is winning is on TBCB route. TBCB is where the transmission authority will put up a project for bidding, and they will mention the cost. Whoever bids the lowest price goes and wins that tender, right? So it's a 35-year project, and cash flows you have. Transmission is seen as the safest asset in the entire infra space. In other assets, let's say roads and all, the revenue is determined by the footfall or how much traffic is there. In transmission, there is no such thing. Even if you set up a transmission, there is zero power flow in the entire year. It's lying unused the entire year. You get the same ROE. There is nothing to do with generation and all. It's the safest, it's seen as the safest infra asset in the entire world. You are allowed to recover. Once you bid a tariff, let's say, you set up a transmission capex of 1,000 crore, and I'm going to get 100 crore revenue for the next 35 years. That 100 crore kind of becomes sacrosanct. It's not determined by generation or throughput and all. So when you look at now increasingly in the ISTS, 90% of the projects are now coming through TBCB. It's only certain strategic projects, some lay project and all, which are going on regulated nomination basis, which is where PGCIL will typically come in. And others are going through TBCB. In intrastate, which is the other opportunity I mentioned, if you look at the entire transmission capex, as a country, we are looking at 9 lakh crore transmission capex till 2032, from now till 2032, of which 6.5 lakh is ISTS, about 2.5, 3 lakh crore is intrastate. Intrastate was outside the purview of developers historically, but a lot of states are now coming up with policy that above a certain threshold, if the size of the project is, let's say, more than 100 crore, 200 crore, it has to be compulsorily given to TBCB. Historically, it was all state transmission utilities, which was, let's say, any state will have their own transmission company, state transmission company. It would default that entire opportunity was going to them. Now, there is policy that above a certain threshold, it has to go to competitive bidding and anybody can come and participate. The challenge is it's there in policy in the country. We definitely have some policies, but it's not put to action. In many states fear that if other players come in, it's going to disrupt the market. So the policy is there, but actual implementation is somewhat lax. So that entire intrastate opportunity is there on paper, but we'll see on actual execution if it opens up or not. But let's say if you look at the entire intrastate opportunity, which is 6 lakh crore odd, a lot of it is going to go to TBCB. Historically, PGCIL was 60% of that overall market, TBCB. Whatever TBCB that I showed auction value, Power Grid was winning 50, 60, 60, 65% of those tenders, but mainly because of the interest cost advantage they had. Now, the IRRs have improved, the market has become so big, it's allowing other participants to come in because other players were not able to compete with Power Grid on the interest cost and they were not able to match the tariffs. So when I showed equity IRR of 12 odd percent, and that, so this is purely a function of, there are only two variables, revenue by gross block and your interest cost. This number has improved, which is indicating to you that IRR has improved, but these two numbers are enough to give you, to be able to help you to model IRR. But historically, as I mentioned, the good thing in transmission is that when you look at revenue by gross block and all, or any other metric, when you look at hydro we get 16% ROE, but it takes you 10 years to commission that plant, right? So you put up 100 crores of capex over 10 years, and then you start getting 16 ROE. Your IRR, when you calculate discounted value of cash flow, may not be even 10, 11%. In transmission, your gestation period is only 2 years, 1.5, 2 years. Unless it's HVDC will be 4, 5 years. But typically it's renewable, both these are low capex, low gestation period, which is what, when developers are bidding, right, they have all the information. When say PGCIL and others are bidding, they already know that it's a 2-year gestation, it's sacrosanct cash flows. And if it's a competitive tender, they're ultimately trying to model for IRR. So, and that will be a function of the supply, demand, and the cycle. But the players that are there in this are largely Power Grid, which is a bigger share, Adani Energy Solutions, which is the second biggest player. And then you have Tata Power, Torrent, and all also participating as a developer. Then you have obviously capital goods, which are transmission companies which supply equipment. But as a developer, largely these 4 or 5 would be the large big players.
Yeah, hi. So I have 2, 3 questions. One is on battery. How does that compete with pumped hydro as a alternate solution in terms of storage? And second is, what happens to the battery replacement after 5 to 7 years of life cycle? Because the solar plants are set up for 25 years. So how should we cover for that risk? And last question would be in terms of the closed bids in storage solutioning. What would be the target threshold IRRs which all of these players are seeking for? Thanks.
Good questions. I didn't put, I think partly some of these will be there in the next battery one also. But for the benefit of audience, pump storage is basically, as I mentioned, you have solar that typically can't be stored, and you're generating excess solar during the day. So you need some kind of storage that can store that energy during the day and helps you meet that demand in the evening. And there are 2 ways to store it. One is batteries, the other one is pump storage. Globally, these are the 2 main sources, and we'll talk about some other sources which are emerging, which can play out over next maybe decade or so. But as of now, these are the 2 main ones. Pump storage is basically you're using solar during the day to pump water up, right? You're just using electricity to pump water to an upper reservoir. You have 2 different reservoirs, an upper reservoir and a lower reservoir. Using a penstock like a pipe, there is water in the bottom reservoir. You move that water up and store it in an upper reservoir during the day, and you're using solar during the day. During the evening, the water comes down, and the process it rotates the turbine, and that generates electricity. So it's called a water storage battery, water battery, and all. It typically has 4 or 5 year gestation period, the execution risk is higher there compared to batteries. Historically, what we've seen, because there the capital cost, when you look at battery, is largely, as I mentioned, semiconductor, it is technology. Battery is a proven technology for many years, and there is nothing relatively new happening there. It's like a hydro dam, right? You can't really recreate an entire hydro with a different technology. The capital cost typically would be anywhere from 5 crore to 6 crore per megawatt. And that will take about 4 or 5 years to execute. And we still need to see, there is actually a Tehri Dam PSP which was going to come up this year by NTPC in Tehri. It's been delayed for many months. There are other developers which have been trying, and there have been delays. So there's an execution risk which we need to monitor. But typically the benefit, so the discharge cost, right? So you look at two costs. One is the capital cost here. So in storage, you have two components. One is fixed cost, which is the cost you incur for capital for setting up a storage plant, whether it is battery or pump storage. The other one is a variable cost here, which is the cost of charging the battery, which is the cost of solar and all. So when we look at the levelized cost is the cost where the plant becomes break even, where it is generating cost return equal to desired return. That discharge levelized cost, or the cost at which they are discharging power for pump storage, would be anywhere from 8 rupees per unit plus. But the benefit of pump storage is it gives you 6 to 8 hours of discharge, right? So you move water up, and then when you move water down, it's giving you, the sun is not there from 6 p.m., and it gives you 6 hours, 7 hours of battery storage. That number for batteries that we talk about, battery energy solution, was 17 to 20 rupees unit 1 year ago. That number right now is 7 rupees, 6.5, 7 rupees per unit. So it's becoming competitive with battery, with pump. But the only challenge is right now it gives you only 2 hours of storage, or 4 hours maximum. You can oversize a battery BOP by, we'll talk some bit in the next one, by oversizing a battery pack and make it a 4-hour solution. But typically it's difficult to meet that long duration storage. So you have to put multiple batteries. So both are going to be complementary, but lower battery prices, when we look at that peak demand that we have to meet. As I mentioned, it is thermal, it is natural gas also, it is wind, and it is storage, and it can be pump storage or battery. Battery prices coming down has been a risk for everybody else, right? So that battery was out of equation, and suddenly it just become in and eaten up market share from everybody. But we'll have to see. There is a possibility everyone has a role to play. How much is a question. Everyone will have, but if battery prices continue to go down, they will keep on getting higher share of that pie.
Hi, sir. I have three questions. One is regarding thermal power plants. There has been a recent upsurge in the new capacity addition plans. Some 50 to 60 gigawatt of new plants are being in the ordering phase. And if you compare it with last decade, there was very few orders, very few capacity addition plans. So the reason suddenly government realizes that we need so much of capacity in thermal capacity is a sudden realization, or it was more of a political per se? It's logical, or was it political?
Political would be difficult to answer, but generally what has happened is partly the entire energy transition. This is not just India we're talking about. If you look at what has happened in Europe in the last 2 years, right? They were also building this entire energy transition. Same thing happened in Australia to some extent. They thought a coal plant will shut this year. The biggest coal plant in the country will shut this year, and they will have X number of X solar and wind, and then may not need so much thermal. And now they're realizing that we need energy security also, not just energy transition, right? So when the country now talks of both transition, and so the word security was missing. Now the word security, which is why for security you need all these, as I mentioned, coal, wind, coal primarily, but now you're seeing others compete. But historically, we were looking at only transition, not security. And suddenly your demand in the last 3 years, I mentioned, was growing at 10% per annum. Nobody was building in more than 5-6% per annum. And suddenly you have this massive surge, and people started looking at new sources like data centers, green hydrogen and all. So partly, I think the kind of demand that CA was modeling Historically, what has happened, to give credit to maybe CA, whatever they modeled in the last 10 years, actual demand was consistently lower than what they were modeling. So they were basically being too aggressive in their demand estimates. So now they were also coming up with that mindset that we can't be too aggressive. And suddenly, it's like a typical capital cycle. You're projecting lower demand, and suddenly demand went up. And that caught really everybody. So it's a combination of being too comfortable and not really seeing this entire energy transition. It might have delays and all, and not basically expecting the surge in demand. And now you're seeing not 50, 60, actually a few months ago it became 80 gigawatt, that we may need 80 became, it started with 50, then 60, 70, 80, 90, it went to 90. And now there is people are fearing that the demand this year has been low, and that earlier we were looking at 8% demand CAGR for the entire decade, right? So suddenly this year demand has not really grown to that extent, and battery has really prices declined. So do we need as much thermal, right? If we don't have as much demand and if battery is able to meet. So that's the other two different variables we're trying to solve. How much demand will be there, and of the non-solar peak, and of that demand, how much can be catered by wind and batteries. So that coal capacity that we need will be a function of these variables.
My second question is that these new transmission line for RE, which you were just discussing, like we already have a traditional system, not HVDC, but at least the normal three-phase system. So especially for RE, why do we need new lines? Like, can't we simply carry with these lines?
We don't have enough spare capacity within the existing. The transmission system you build is based on certain utilization and also the throughput and all, based on what we have. And remember, we have to also keep in mind all the REs coming up in Rajasthan, Khavda and all. If you look at Khavda, there is no transmission line currently, right? So in Rajasthan, we didn't really have thermal power plants. The costliest thermal power plants in the country, when you look at coal plants, are actually in Rajasthan and Gujarat, because they rely on imported coal. Those are when I talk about the merit order dispatch and the highest coal plants, cost plants, they will be in Rajasthan, Gujarat, and South, Tamil Nadu and all. And there is not much transmission that was required historically from there. Now you're needing more transmission. So it's a combination of new sources. Right now, when you look at Khavda in certain places of Rajasthan, they are the most concentrated solar regions in the entire world. Khavda is the most concentrated solar region in the entire world. You have 50, 60 gigawatt of capacity coming up in 400, 500 square kilometer area. In world, that is the most concentrated region. Same is in Rajasthan, which is why you're seeing transmission shortages. Government is saying if you want transmission, evacuation in certain places in Rajasthan and all, it cannot get commissioned before 29. That's the lead time that is now there for certain places. So in the same line, we don't have enough spare capacity, and also the new sources are different from where they were. So it's a combination of both. If we had spare capacity, that was a clear solution. In certain plants, we still have the CTOIL, which is transmission planning body, gives data on each transmission line that is there, and they mention how much spare capacity is there. So when we look at the entire CAPEX, it's already building in that some spare capacity we can utilize from the existing network, but beyond that, we need so much capacity. So it's already part of the plan.
So last question is that, these TBCB model, these private companies which are relying on that 80% leverage.
Sorry, 80%?
80% debt they were using now in TBCB model, the private players.
Yeah.
So even in the case of if they're not able to meet their solvency, their debt needs, debt repayments, in that case, the long-term PPA with the discoms and all, will that get be affected if they get into insolvency and all?
So when you look at, I didn't fully understand the question. When you look at transmission, it is 35-year, right? Transmission TBCB is 35-year contract, PPA.
Yes, sir.
So you get, when you bid for 35-year of revenue stream.
But in 35-year, like you can get insolvent also, na? Like if you are not able to...
Right. I thought you mentioned shorter PPA, but yes, it's typically when you layer on debt, it's a function of how much DSCR, the debt service coverage ratio, the bank is comfortable with. So you cannot typically you go to 75, 80% also, but it's got to be what bank is comfortable with. And then debt repayment. So your interest cost is going to be higher. Let's say it's 9.25% before you commission the project. Once you commission the project, it drops down to 9.25% or 9%. And so because you have more certainty of cash flows. And debt repayment will be a function of the debt service coverage ratio the bank is comfortable with. But the risk is there in TBCB. So both comparative model, you're talking about both renewable and transmission. Because in that also you have 25-year, you have 75% 80 debt. Here also you have 75% 80 debt. Generally the risk can be multifold, right? One of the biggest risks that was seen was when YSR, when new government came in Andhra Pradesh, and they said solar tariffs in the country are dropping, and we want to renegotiate the contracts. And that if we are getting new contracts at 2 rupees, why do we buy power at 4 or 5 rupees that we entered? It went to Supreme Court, and Supreme Court said that you cannot renegotiate existing contracts. If you do that, nobody's going to invest in the sector. So that there's a Supreme Court precedent that you cannot tinker with the tariffs. There are different mechanisms in the contract, tripartite agreement and all, to make sure that if one party is not paying, the RBI is also there as a counterparty in some of the contracts. But generally, if obviously like any contract, if the demand suddenly is not there, DISCOM is not able to pay, then you have, as I mentioned, over time, the security mechanisms have been built in these tenders, a tripartite agreement and all. But risk is obviously in a capital cycle when you have high debt projects, it's a leverage buyout model at the end of the day. So there can be a risk. But by and large, there are some mechanisms which have been put in over time, but which is what for analysts, investors, also we're all trying to evaluate that if the cycle turns and you have such debt and your EBITDA is not there somehow, then what is the risk? Do you need to go back to equity market and all? As analysts, that's an important part of our job. But that's for investors, that risk is obviously there in any capital project.
Thank you.
Please settle down, everyone. We're starting second session, which is battery onshoring supply chain.
Hi, welcome back. I'm glad. I think the last session was probably more challenging. You guys came right after lunch, so that explaining a complicated session just after lunch was a task that was interested. But now after tea, hopefully this is even going to be more complicated and more complex. When I was actually debating, I cover multiple sectors. I cover metal, cement, power, and now batteries also. I was debating between battery and cement for the last session. Given cement is consolidation, we did some podcast with Zerodha on how the cement industry is evolving. But I can see from the audience that there's a lot of interest in batteries and there's some awareness of what's happening in batteries. So we, Ambit, I briefly mentioned in the last session, we also have Daiwa, which is one of the largest players in Japan. They invested about they are one of the largest shareholders now in Ambit. So we leverage their expertise in batteries and solar and wind, all of this, especially in batteries, on what's happening globally in China in batteries. So we put out some notes, thematics on this entire journey on battery manufacturing and all these plays you look at in India. There's a lot of excitement on this entire story, on economics and what's happening globally. So in this entire discussion, we'll focus on the trends that we're seeing across the globe, we delve deeper into the process of battery, largely lithium, but also some other technologies. And then we look at economics and some bit on PLI economics and what's happening in India, who are the players, where they fit in, what is the opportunity, some economics, does it make sense right now or not, what is required for it to make sense. When you look at battery manufacturing, battery demand, a bulk of demand is actually EVs. Stationary storage for power is there, but it's relatively small right now in the overall pie globally. So the entire demand has really taken off in the last 5-6 years. So we're sitting at 1,000 odd gigawatt hour of demand. And as you can see, bulk of it is EVs right now. So this is the pie for overall demand. As you can see, largely EVs. Stationary storage will be 15-16% of overall demand. This is also like any capital cycle that we look at. Last session, we were talking about capital cycle. This is another perfect example of capital cycle and how this entire capital cycle globally busted in the last 2 years. Till after COVID, demand was doubling every year for batteries. And people were extrapolating that this demand will keep on doubling every year for the next decade. Right? That is how, and typically it takes you about 2-3 years to put up capital, put up capacity for battery. So imagine a situation, you're sitting in 20, you're expecting demand to double every year and reach, let's say, 6,000-7,000 gigawatt, or maybe more than that by the end of the decade. You start putting a lot of capacity and demand doesn't come. So that's what we're going to look at as far as global story is concerned. So demand was growing, doubling. In the last 2-3 years, there was a significant slowdown in overall demand. Partly you had COVID-led entire decarbonization, ESG focus, lower cost of capital, but also your interest costs started going up in the last 2 years. There is range anxiety for batteries. There are multitude of reasons why the demand has really tapered in especially the developed world, US and Europe. In China, actually, the battery demand is still fairly robust, despite the slowdown that we're seeing in China. It's mainly what has happened in other countries, that your demand, which was doubling, has slowed down to 20-30% per year in the last 2-3 years. So you can see China, the EV penetration rate is still 50-60%. There are various reasons. People in China like EVs. They think of them like smart toys. Cool technology, it can automatic parking, and the various features that people have built in those. It's seen as a very cool product, and which is why the penetration rate is so high. In other countries, it's not taken off to that extent. The penetration is still 10-15%. But you had a situation where, as I mentioned in the last, your typical capital cycle, everybody started putting capital to work. And as I mentioned, Marathon Asset Management, in a very good book, when we look at any capital cycle analyst is actually asked to read that book called Capital Returns by Marathon Asset Management. As I mentioned, any business cycle is driven by capital cycle, nothing else. There is an influx of capital in the sector because of incentives, demand growth. There is a pureed food company. Imagine a food company. They said, we want to diversify and enter battery manufacturing in China. It's like a typical dot-com boom and bust where the new buzzword is battery and everybody wants to get into it. And the capacity, because you're putting capacity in 2020, by the time it comes in 22, 23, demand growth has slowed down to 20%. Then you realize there's massive overcapacity. So right now we're looking at 2,000 gigawatt of battery capacity globally. Your demand is 1,000. So utilization level is 50-60% globally for batteries, which has led to erosion of profits for everybody. It's like solar module. If you look at global solar module, cell, polysilicon, in the entire capital chain, everybody is operating at 50% utilization and bleeding. Every single company is largely bleeding. Same thing in battery right now in the world. So you can see till 21, 22, the supply demand was largely in sync, right? And your utilization level was 90%. Last 2 years, your demand is not growing, but capacity has doubled or more than doubled, and utilization level has dropped to 50, 60%. Uh, 2 years ago, few months ago, we were looking at a situation based on announced plans that the world is going to add 8,000 gigawatt of capacity by the end of the decade. Everybody was asking a question that even if every single car sold in the world by the end of the decade is EV, even then you don't need so much demand. That is the extent of overcapacity everybody was fearing. The good thing is, in battery, if you look at the entire supply chain, if you look at steel and many other industries, it is state-owned enterprises which account for more than 50% of Chinese capacity. In battery, that number is not even 10%, which means the supply is more fungible. Most of these expansion plans that we've seen that were put out by various agencies several months ago, most of them have been cancelled, which is a function of lower profits, shrinking profits, and all that. Most of these have got cancelled. And the utilization level, which is what our partners, as I mentioned, Daiwa, is expected to have bottomed out for lithium-ion battery manufacturers, because in the next 2 years, you don't really have as much capacity coming online because all these plans have been cancelled. And in demand, let's say if it grows at 20%, there's a possibility that this utilization is at the bottom of the cycle and you see some pickup there. These are the large players globally in battery manufacturing. When we look at the money they spend on R&D and their profit margins and all, CATL, a Chinese company, by far the biggest player in batteries globally. When we look at a battery, typically by and far, you'll think of CATL only and BYD. These are two largest players in battery. BYD will be partly captive, and we'll see maybe like Ola, what it is doing, maybe replicating to some extent what BYD is. And then you have some Korean companies also. But by and large, these two companies will be more than 50% of overall market share. This is the total, let's say if you split 1,000 gigawatt hour, as you can see, EVs would be a big chunk of it. This is the current 1,000 gigawatt hour demand. And this is on the x-axis, the penetration rate right now. This is indicating to you how much more penetration is possible in some of the applications. This is given by IEA, some global agencies, that by 2050, what is the proportion of demand that could be catered to by batteries and various sources. In India, in Europe and all, some other countries, there is wind. So wind, as I mentioned, you're trying to solve for that peak demand, right? So this is largely looking at that peak demand. In other countries, wind, PLF that I showed earlier in the slide, wind PLF is very high. They get very dense wind. And also there is possibility wind is more competitive, and then battery has to compete with other sources. But in India, it's largely, a bulk of it is solar plus batteries that we are looking at. So that is the potential share that is mentioned by, I think, for some reason, the legend was basically countries. The middle one is India. The other one are different countries, but maybe it got cut. This is showing the battery, similar to the chip war that I was talking about. The number of transistors on a chip have kept on doubling as per Moore's laws every year, which is why semiconductors, everything has become cheap, solar module. Same thing with batteries. It's becoming more efficient. Density in a way is how much watt-hour, how much energy you get per kg of battery. So the more energy you have in 1 kg of battery, the better the range of an EV, right? So that density is one of the main building blocks for EV. And there are other technology improvements which have happened. We'll go through some of them in this. And because of economies of scale, over time you hit a curve where the economics start, you reach a scale where you start an inflection point, and then economies of scale also help in reduction of overall cost. But massive reduction in cost in batteries. We'll look at where the battery costs are right now across the entire value chain. Because this is the delivered cost. This is a cost of a pack, but we'll look at economics of cell, pack, the entire BESS system. In the previous one, we showed that module prices have dropped 99.9% in the last 50 years. Same thing is happening. Batteries in the previous slide, we have longer evolution, but this is showing cell and pack level cost. Right now, the lithium pack is about, which was $300 per kilowatt a year, maybe 2-3 years ago, is now about $70 is the price that we hear in the market. So that was the global trend of what we are looking at. There is upstream, downstream, we'll look at both components, but we are in a world where there is massive overcapacity globally for batteries, for lithium-ion, and then we look at various other technologies that are emerging. But there's a possibility that utilization level has bottomed out for batteries if the demand growth is higher than supply. Now let's look at the process. So the building block is a cell, series of cells, you have modules, packs. If you see, this is a model for a Jinko Solar battery energy storage solution. This is when we talk about power, that you need battery to store power and discharge power, right? That batteries typically have, failed to mention for our audience who may not have known so much about batteries, there are two, as I mentioned, two ways it is used. One is in EV, the other one is in generating power, discharging power, storing power and discharging power. When it is used for storing and discharging power, it is called energy storage system. It is store of energy. The other one is EV. It's a pack. It's a movable. It's not stationary, right? So this is a model for a stationary storage model for power, where you have the entire BESS. It's called battery energy storage system. It has a series of packs, battery packs. It has the entire capsule. It has inverter. It has battery management system. That is what a BESS, a model for a BESS looks like. So the process is, the building block is lithium. We're looking at lithium here, but we look at other chemistries also. Let's say LFP, which is the predominant technology right now. The first starting point is you get raw lithium. And there are two ways you get lithium. One is from hard rock, it is called spodumene, which is something you get from Australia, largely Australia. The other one is brine. It's a salt pan, typically found in Chile, Argentina, and all. So you get lithium from there. You dry it in a pond and all. You get at the end of the process, and then you concentrate. You improve the percentage of lithium within what you get. It's like copper concentrate, zinc, any other process that you have. The end product of this is called lithium concentrate, which will have 6% lithium in it. Right? That's, so when you're looking at miners and all, they will be producing lithium and selling lithium concentrate. The next step is lithium refining. They will take raw lithium, process it, and make lithium concentrate, LiCO3. That, there is only one refinery in India, in Gujarat, I believe, but otherwise it's largely in two places, China and Chile. Then once you have LiCO3, lithium carbonate, that is when the first, in a way, you can say midstream process that we're looking at in India or other countries starts. You take the lithium carbonate, then you combine iron phosphate and some other, basically lithium carbonate and iron phosphate would be the bulk of the raw material, and you make something called LFP powder, a cathode active material. So when you look at the likes of companies now looking to get into this space, Epsilon and Himadri Chemical, GFCL, all these companies, when they talk about battery chemicals, they're talking largely about cathode active material, LFP powder. You are taking lithium carbonate, you're taking iron phosphate and making that LFP powder. That's the next stage. That is where midstream, and similarly you do for anode active material. Yeah, so this is the chemistry, we'll go back to it. So one, you're trying to make cathode active material, which, and we'll talk, so the powder is called LFP powder. The other one is anode active material. It's from anode and the chemistry is largely graphite. And then you make separator and all these electrolyte. These are the four components you make in a midstream process. Midstream process ends there. After this, starts downstream process, which is battery manufacturing. So in battery manufacturing, there are three steps. One is called electrode manufacturing, the other one is assembly, and the last one is testing. In electrode manufacturing, you are manufacturing, electrode is either cathode or anode. Cathode is basically, you take the LFP powder from all these companies that are making LFP, You take binder and solvent and you make a wet slurry. It's a wet slurry, and then you coat it on an aluminum foil. That coating on aluminum foil, that becomes cathode. Right? And we talk about dry slurry also, which Tesla at one point Ola was also talking about. But basically, globally, it is wet slurry that needs to be dried. Um, that is cathode. Similarly, you make anode. You take anode active material, binder, solvent, coat it on copper foil. Because one is a positive current collector, the other one is negative current collector. That becomes anode. So that is the first step of battery cell manufacturing, electrode manufacturing, where you're manufacturing cathode and anode using these materials from midstream producers. And that is the heart of the process, battery cell manufacturing, because the entire yield output you get, you make 1 gigawatt hour, 10 gigawatt hour factory, but you're able to get only 6 gigawatt of output, 7 gigawatt. The biggest variable is battery cell, is the electrode manufacturing. And we'll talk about what various companies could and could not do in this various process. Not every company will look at, various companies looking at battery cell manufacturing, getting into battery cell. Not everybody is going to do end-to-end. There are companies which may buy electrode from China and do only cell testing, assembly, and all. And there are other players which may actually do the entire end-to-end. So once you make battery electrodes, then you basically combine, the next step is assembly. You put cathode, anode, you insert electrolyte solution, you have separator, and that makes your battery cell. So when you look at the chemistry between LFP and NCM, typically the only difference is in the cathode active material composition. In anode, it's largely graphite. Silicon is typically better, gives you better performance, but it has much higher cost versus graphite. So globally, when you look at anode, it's predominantly graphite. But when you look at cathode or LFP powder, which or that cathode active material, that can be either NCM or LFP. When you look at LFP, as I mentioned, it's lithium carbonate, and largely LFP is L-lithium, Fe is iron, and P is phosphate, lithium iron phosphate. And NMC can be nickel, manganese, cobalt, or various combination of all of these things, right? So the only difference between NCM and LFP is largely the cathode composition. Anode and electrolyte separator is largely going to be similar. That's the only difference. This is just showing the evolution in different countries, but largely NCM has better energy density, which means that you need to be able to generate the same energy output, you need lower kg, lower weight, which is why it was preferred for electric cars globally. NCM was a preferred chemistry. And then you had other evolving chemistries. But what really has happened in LFP has really surprised everybody. They have, and we'll show in subsequent slides, the cost has reduced significantly for LFP, and now it is 30-40% cheaper versus NCM batteries. The energy density gap, so let's say historically, the energy density for NCM was 250 and LFP was 120. The gap has reduced to, let's say, 200, 250 and 200. The gap has reduced significantly. And on the other hand, your cost has become 30-40% cheaper. So in battery energy storage, your density doesn't matter. It doesn't matter how many watt hour you get per kg, it's stationary storage. In EVs, it matters. EVs is a function of density because it gives you better range. So when we look at stationary storage, it is predominantly globally only LFP. When we look at EVs, barring two-wheelers, where if you look at Ola, the battery it is setting up, it is largely NCM, and some very high-end cars, which you don't mind paying a higher price for the slightly better range it gives you. A lot of EVs globally are now coming up, are also LFP now. So that LFP has really taken significant stride and market share in China, and now other countries are also predominantly moved to LFP. In India also, there were players looking at sodium ion. We'll talk about sodium ion also. Companies acquired different companies globally, thinking sodium ion is the next big thing. There is so much sodium in the entire world and all, that it's a cheaper source. But what we've seen in LFP, the massive economies of scale, massive reduction in cost, and all, and better performance. They've bridged the gap. And we'll talk about cycle life also. So the battery, as somebody else was asking how many years you get, and actually I didn't answer, I realized I didn't answer the question fully. But the question in the previous session was how many cycle does it need to be replaced? So if you're setting up a 25-year module PPA and battery needs to be replaced. So that when bidders are bidding for that project, they already take into account. Historically, the cycle life in a battery project in LFP was, let's say, 2,000 cycles. So if you're running one cycle every day, 2 hours, you're charging it for 2 hours, discharging for 2 hours at one cycle. So let's say if you have one cycle only for 365, 1 year you have 365 cycles, and you exhaust the entire battery pack in 5 years, if you had 2,000 cycles. Now the current batteries have cycle life of as high as 7 to 10,000 cycles. So the need to replace battery is also, the tenure after which the battery pack needs to be replaced is also increasing. Now the question is, can you run 2 cycles a day? So you charge, discharge, the battery is fully discharged, then you charge again in the, maybe using wind in the evening, and then discharge again. So you have 2 cycles, and then it becomes 730 cycles a year, and then even then you can have more than 10 years before it needs to be replaced. So there are various improvements which have happened in the entire performance over time. Density is one, then you have the cycle, the number of cycles that a battery runs. All of these have significantly improved over time, and which is why I mentioned LFP has really taken significant market share globally. So this is showing where the lithium reserves are. Largely Chile, Australia are the predominant ones. This is showing that China typically prefers spodumene. You have 2 sources of raw material, either spodumene or brine. Typically, they tend to prefer spodumene because the cost of refining spodumene is lower versus cost of refining brine. So your overall cost of making lithium carbonate would be relatively lower if you're using spodumene versus brine. So this is the model that we showed. So when you look at a battery cell manufacturing, as I mentioned, there are 3 steps. One is electrode manufacturing, assembly, finishing, right? In manufacturing, you have making a wet slurry, then coating it on aluminum or copper foil, depending on whether it is cathode, anode, and then slitting and drying. That is the heart of battery cell manufacturing. That is about 40% of overall capital cost. And then you have other processes. Now, the PLI, if you've got PLI, let's say there's Ola and Reliance which have got PLI, and there are others who have not. The PLI mandates that what percentage of value addition you need to achieve. So you're getting, typically in PLI, you're able to recover 40-50% of your capital cost on a battery cell manufacturing. Right now, the way PLI is structured. But to be able to get PLI, you need to achieve certain target, and there is a value addition. Value addition is basically sales minus cost of raw material in a way, and then divided by sales. So the cost of raw material and how much value addition you achieve is a function of, do you do the entire end-to-end or you do only piecemeal? If you do entire end-to-end, your value addition increases because you're doing everything in-house. If you don't do in-house, your value addition decreases. So the mandate is to have 60% value addition within 5 years. Even if you do end-to-end, you cannot meet 60% right now. But that's the starting point to be able to achieve the target as per PLI. So if you have PLI, there is no option but to make electrode in India. And to be able to make electrode in India, you need raw material largely in India to be able to meet 60% value addition. If you don't have PLI, you can bypass the first process. Let's say if you have a player, hypothetically, let's say Amara, Raja, Excite, they're all entering. They don't have PLI. They have Chinese partners, Goshen and others. They can bypass the first step, get electrodes into India from Goshen and their Chinese partners, and do the only assembly and finishing later on. That's capturing less percentage of value addition till they actually figure this out. But it's also in a way de-risking the project. And they have so when you look at who is setting up how much capacity, it's not an apple-to-apple comparison. Somebody might be doing end-to-end, others may not be. So the capex cost would be low. If somebody is not doing end-to-end, your margins would be low. Anybody doing this, entire thing is getting higher PLI benefits, but it's also carrying more risk because this is a technology. In the other one, you're relying on Chinese partners who've already figured it out. In this one, as I mentioned, this is the heart of the process. This is where the chemistry lies. If you mess this up, your yield is going to be lower, your economics is going to be lower. So that's in a way, this is high return, high risk, and in a way, the government is giving you 40-50% of capital cost for taking on this risk. So when you look at the overall cell raw material, so this is when you look at the entire bill of material for a cell. Cathode is the biggest one, and will go through the entire bill of material for a cell. And then you have anode, electrolyte, separator. So you can see when different companies are operating, some companies would be making electrolytes in India. When you look at battery chemicals, some will be doing others. And you can see the percentage of the overall battery raw material cost, they will be accounting for all these different players. So, like anything else, whether it is solar modules, steel, or any process you look at, it's predominantly China. So, majority of the lithium, as I mentioned, comes from Chile and Australia. Australia's spodumene, Chile brine. Most of the processing happens in China. They have all these massive refineries set up, and they refine lithium into lithium carbonate. And China is also forward integrated, Chile, where they mine lithium and they also produce lithium carbonate. So this is the share of China across the entire value chain, from making these all these materials, then processing, making cathode, anode, making battery, making EVs. It is like anywhere you see in solar modules, steel, they are the dominant one across the entire value chain. They've captured significant lead because they've been investing in this for the last 7, 8, 10 years. Massive lead, massive R&D. Cattle, I'm not sure, maybe they're in the future slides, but Cattle spends about $2.5 billion only on R&D each year. That's the scale we are looking at in China to be able to compete. But we do need a lot of duty support. I'll come to that. But many countries are now seeing this, that it's predominantly China. And if we need to have battery as a part of overall power production, EVs, we cannot rely only on one country. So there's a lot of focus on onshoring, which is something we're seeing in solar module and now in battery, given the government incentives. So these are different technologies comparing LFP with sodium ion solid state. Typically, when we look at solid state, sodium ion, there was a lot of interest early on, but given the economics 2 years ago, sodium ion was $300 kilowatt hour, LFP was 300. Sodium ion is still 300, LFP is now 70, 80. So it's massive difference in cost given what has happened in LFP. And they've bridged the performance gap also on density and others and all. They're actually better LFP versus sodium ion. So sodium ion looks difficult for EVs given the density is lower. But anyway, it's something where we were seeing a lot of interest even from cattle and all. The interest as of now, unless something changes, seems relatively low. Incrementally, we're seeing some capital being deployed in China on solid state. Solid state is basically the biggest difference is electrolyte is typically liquid. In others, it is solid electrolyte, which is why solid state battery. But as I mentioned, LFP has seen significant improvement. It is largely everybody is going LFP way right now. So as we were discussing massive overcapacity across the entire system, there is hardly anybody making money right now through the entire value chain. And the highest bleeding is actually happening in midstream. But every single player has been bleeding, which is why you're seeing some supply rationalization. You're seeing lithium prices correct because there's oversupply of raw lithium. You've seen lithium carbonate prices shrink because lithium prices have come down, but also the margins of lithium carbonate refiners who are buying lithium and converting into lithium carbonate, they've also shrunk. And this is just showing the cost of processing spodumene versus cost of brine. So it's typically spodumene is preferred because the cost of manufacturing lithium carbonate is lower with spodumene versus brine. But this is showing you lithium carbonate prices and the LFP prices. Obviously, LFP takes about 13-14%. Lithium carbonate and other raw materials are going to be cheaper. But the two raw materials are lithium carbonate and iron phosphate. You're seeing prices for lithium carbonate decline, but prices of LFP have declined even more. You can see the implied processing fee for LFP. When you look at, let's say all these players talking of cathode active material, the likes of Himadri, GFCL, all these battery chemical players, they will be buying lithium carbonate, iron phosphate, and largely a converter business. You're buying raw material from outside and converting into LFP powder. So there's an implied processing fee. You can see the LFP price, you can see the lithium carbonate price, and in a way the difference is indicating to you the margins that LFP producers are charging over raw material. That's been shrinking because of the overcapacity you have in the entire system. This is the bill of materials for a LFP cell, that you need 2 kg of cathode active material. It's also indicating to you that per kilowatt hour, this is the amount of cathode active material we need right now. And that number has also shrunk over time, which is why you're seeing better economics, better performance. But as of today, as we speak, it's about 2 kg of cathode active material per kilowatt hour. So if you, whatever number you look at, that as a country we'll have 100 gigawatt hour of battery capacity in the country, you can multiply this to say 2 lakh ton of cathode active material demand, whether it is catered to by India or outside, but that's the demand potential out there. Same is anode active material is about 1 kg per kilowatt hour of anode active material, and various others. And you see the per unit cost right now. That has declined sharply over time, which is why the entire raw material cost for battery has shrunk to $30, $35 per kilowatt hour. That's the raw material cost for making LFP cell right now. And as I mentioned, the reason why prices have dropped is because you're seeing prices shrink across the entire value chain. And obviously, partly over time, you've seen the amount of consumption you need per kilowatt hour has also come down because of technology improvements. This is what I was showing. Cattle spends about $2.5 billion on R&D each year, and that is why they're able to churn better products, more products. So if you look at margins, cattle is still able to make money because they're operating at, the entire system, as I mentioned, is operating at 60% utilization. Cattle, because they spend massively on R&D, they're able to improve products, give better products. They're also spending some R&D on and putting out on solid state and all also. They're able to operate at higher utilization, and they're able to be profitable. But they are a standout where a lot of other players are bleeding right now. And you can see the right-hand side is actually battery cell manufacturing. The left-hand side is the LFP producers that I was talking about, the midstream guys, where a lot of battery cell chemical companies in India would be looking at opportunity. That is where there's only one company that is, or possibly two, that are still partly net. These are net profit margins. So one is gross and net. But largely, if you look at the net profit margin, there's only one Chinese company, the first one, that is generating some positive net profit. This is the LFP. And the right-hand side is the battery cell manufacturing, who are buying these LFP and making these battery cells. So this is the waterfall for a battery cell, going from raw material to the delivered cost of, that's the turnkey cost of putting up a battery energy storage plant. So you start with raw material. That's the current price that we see in China. So you start with raw material, as we discussed, the bill of materials about $35 per kilowatt hour. The fixed cost is minimal because the interest cost in China is 3%. It's an economy which has massive oversupply of savings in the economy, right? So it's massive oversupply of domestic savings, which keeps the interest rate low. So all industries in China, whether it is steel, semiconductor and all, are able to borrow at 3%. If you open any balance sheet, typically interest cost for all these companies will be 2, 3, 4%, not more than that. And the other thing is that at current prices, they're not able to recover depreciation. So the fixed cost and not able to earn profit. So when you look at fixed cost, it's a combination of depreciation, interest cost, PAT. Right now, there's no depreciation, no PAT, only interest component, which is also only 4%. So fixed cost is very low right now. And so the LFP cell in the market from China is about $45. And NCM would be about 30% higher than that. This is only LFP that we're talking about. And then you go from cell to pack. So $70 that you see is the cost of pack, the lithium-ion pack, and NCM would be about $90, $100 per kilowatt hour. And then from there, you go to PCS, which is the inverter, module, the BMS, the EPC, you need transmission. Whenever you set the battery storage, you need land, you need to connectivity. When you look at the entire delivered turnkey cost of battery storage plant, it is about 120 in India also right now. And so that number was obviously $300 or so just 1 year ago. Now it's up to 120. but that you can see the waterfall that how you get to 120 right now. So the question, I'll come to the question, but this is the potential indicated by Niti Aayog in India that by 2030, we may need about more than 200 gigawatt hour of battery demand. This is a demand, and the idea is to basically onshore and set up more capturing manufacturing in India to be able to meet that demand. A bulk, unlike the world where majority right now is EV and storage is only 15%. In India right now, the way we are planning, given the tenders we've seen on storage and all also, there is massive, because of power, meeting power demand and all. It, as per estimates, half of that demand is largely energy storage. So when we were doing this, making this report, one of the questions was that why should India get into battery manufacturing at all? That if there is massive overcapacity globally, nobody is making money, and China has such massive edge, then why get into this at all? And that's the question that you should be asking solar module manufacturers also, that module and cell, that nobody, whatever we've seen in battery, you can actually replicate and copy paste and you'll get module. 50% utilization for module cell, polysilicon globally everywhere in the world. Nobody is really making money. And China has massive R&D edge. Companies make investments in massive R&D. But through various policy initiatives, we've set up the entire solar module chain in India. We started with PLI. PLI here is almost 20, we'll look at the PLI economics, is about 20% of revenue and more in some cases. In modules, it started with 1.5%, 2%. So lower PLI than what we're looking at batteries, but it started with PLI. Then we had BCD, so we have 40% basic custom duty on modules coming into China, from China and others, and then 25% on cell. That was not sufficient because even then we were not able to compete and match the delivered imported cost of cells and modules coming from China. Then we had ALMM. It's basically approved list of module manufacturers you source only from Indian players, and which is why the Chinese price is 10 cents per watt. China is selling modules at 10 cents per watt. In our country, that price went to as high as 18, it's come down slightly. And that's mainly because of BCD, ALMM. If you remove all of this, every single company in India, where you're seeing 25% EBITDA margin or something for modules, every single company will be in the red. It's mainly because of the policy initiatives that we have. And same thing, it's largely to encourage solar. If you don't do that, we can't compete. We'll be relying on China because China has massive economies of scale. We can't match the price China is selling at 10 cents because the economies of scale are there. They've built R&D edge over so many years. They've basically figured out the entire process and improvement done over time. Their interest cost is so low, right? So we can't, their electricity costs are so low. So in India, we have, like Europe, it's the industry which is subsidizing residential customer. Typically, the tariffs that residential customers pay are higher than what industry pays. The exact opposite in India. Industry pays higher, residential pays lower. It is industry which is subsidizing. So industrial tariffs are high. Same thing is in Europe, which is why a lot of manufacturing has not been able to compete. In China, it's the opposite. It's the residential tariffs are higher than industry. So residential are subsidizing the industry. So which is why it's a lot of various reasons that it is difficult to compete and match that price. And even after all these tailwinds China has, that economies of scale, R&D, some benefit on electricity and interest cost, even then nobody is able to make money in China also at current 10 cents. So if we don't do this, we cannot set up solar module in India, which is why we had all these initiatives. Now same thing is going to happen most likely in batteries. We've already seen PLI. When we talk to developers, the idea is they expect similar policy support for battery manufacturing like BCD and all also come in at some point. But the situation is very similar for both solar modules and batteries. So US also started this many countries globally have been looking at onshoring capacity, setting up capacity in their own country. Using incentives given under IRA, Inflation Reduction Act. So they have basically said, and we'll go through some incentives in the next slide, but they're encouraging companies through various policy initiatives, incentives, and duties to set up more capacity within the country. So there is a massive increase in capacity that you've seen for battery manufacturing within US and more pipeline. And a lot of this capacity is actually set up by Korean companies which have gone there and set up. Similar thing you're seeing in solar module, right? The Indian companies going up and setting solar modules in US. When you look at all these developers in India, all these solar module manufacturers, they're also going into China, to US to set up capacity. I think same thing can possibly happen in batteries over time, but first we need to figure it out and set it up within our own country. But right now, Korean companies have already set it up. They are going and setting up these capacities. We'll see how this entire new political regime in US, what kind of incentives, there are too many equations, nobody needs to figure out the business closeness with one particular company versus the entire move against maybe energy subsidies for new energy. So we'll see how this evolves. But these are the incentives US had initially. And there's a possibility some of these actually go away. We don't know how this will. So anybody buying an EV in US was getting $7,500 credit, provided that EV had certain percentage of component of battery material from non-FOEC countries. Non-FOEC is basically foreign entity of concern. These are 4 countries, China, Korea, Russia, and some other country, basically 4 large countries. To be able to get that $7,500 credit, X percentage, this is what is mandated, that over time, this percentage has to be non-FOEC, non-China, non-Korea, North Korea, not South Korea, non-China, North Korea, and Russia and all. So this was seen as an impetus for Indian companies also, given all these restrictions are there and they need to diversify. Basically, US is de-risking the supply chain from China and saying we need more players from outside China to come in and supply. And this was seen as an opportunity for both cell manufacturers in India, if they're making excess capacity and then they can export some cells there, or maybe midstream companies also, because there is a component of midstream also in this, that maybe some chemicals you can make and export to to US. The challenge is now we need to evaluate with, there's a possibility that the $7,500 credit itself goes away in new political regime, and what form and all it takes, that is something that needs to be seen, because this was an opportunity for the Indian players to export, but how this evolves is something to be seen. So these are the plans that were announced. These are the plans that are announced for all the cell manufacturers in India, sorry. So these are long-term plans. As a country, we are looking at, the planning was 100 gigawatt hour of capacity by 2030. We'll see, it's a very ambitious target, given we are starting from the scratch. The first battery cell manufacturing capacity we've set up is Ola, 1.4 gigawatt hour in Tamil Nadu, but there's still a long way to go to get to 100 gigawatt hour. And there are all these players who have announced plans. These are somewhat long-term, so it does obviously not 2030, because if you add them all, it's going to be multitude of 100 gigawatt hour for the entire country we are looking at. So when you look at capital cost for setting up a cell manufacturing, end-to-end cell manufacturing, this is not midstream where you're making LFP powder and all. This is purely cell manufacturing where you're making end-to-end electrode, followed by all the assembly, testing, and everything, is about $80 million per gigawatt hour. That's the capex cost for setting up battery cells. So if you look at 100 gigawatt hour that we're planning, that's about $8 billion of capex opportunity for setting up battery cell, assuming end-to-end, right? So with the caveat that some players may not do end-to-end. And here, as a country, we're already building packs. That's the low. So I mentioned cell, the process is you make, first is lithium, then you have lithium carbonate, then you have LFP powder, midstream. That's when you get into cell manufacturing, you make cell, and then make pack. Right? The end product is pack, and then you have the entire EPC. As a country, we are making pack. We're importing cell, making pack. In Delhi only, if you go there, you'll find pack manufacturers buying cell and making pack. It's a very low value add industry. Even automakers are importing cells. When you talk to Tata Motors and all, they'll be importing cells, making their own packs. That is low capex, low value addition. When you look at the entire solar module chain, the end product is module, it's all assembly. If you go up, it's where the entire economics and chemistry and all work out. So we're doing this already. The idea is to now forward integrate and get into cell manufacturing, get into LFP powder and all of this. But the capex cost, as you see, for others is fairly minuscule. So these are the PLI. We had about 50 gigawatt hour of PLI that was awarded. You had 20 this, and there was Hyundai, which was cancelled and re-awarded. So Reliance now has about 15 gigawatt hour, and Ola is 20. And this is the plan for Ola. So they've already commissioned 1.4 gigawatt hour. Now they've commissioned, but they're not shipping out cell yet. I think that may happen next year. And these are the capex intensity they've mentioned. We'll look at this capex intensity. I think. So this is Ola, based on what they're saying in phase 1 and all, they're saying they'll set it up for 50 to 60 gigawatt, $50 to $60 million per gigawatt hour. And this is typically lower than what we see in non-China, non-Korea countries. About 70-80 is the rule of thumb. So generally what they're talking about is lower capex versus generally believed to be a rule of thumb for outside China and Korea. So this is giving you an opportunity size for midstream. So let's say if we have 100 gigawatt hour of battery cell, as we have domestic, as I mentioned, you need 2 kg of cathode and 1 kg of anode and all these other. So when you add them up at 100 gigawatt hour, and this is the capex that we see typically as a rule of thumb for setting up, let's say cathode is this much million per gigawatt hour and all. So it's this much capacity, and maybe if you do end-to-end, if you do all of them, except lithium mining, it is another $5 billion for the entire midstream in a way. So $8 billion on just cell manufacturing, assuming end-to-end, and then $5 billion for midstream. So this is just showing the economics. One of the biggest challenges in cell is the yield. Typically, for many companies, it's taken a really long period of time to get to 85% output. You have one, let's say, gigawatt hour of factory or 10 gigawatt hour. To be able to get to 8, from that capacity to be able to produce 8 gigawatt hour, 80% utilization, you need to achieve a yield, because there's a lot of yield loss in the entire process. And that is where the entire improvement and processing knowledge and learning curve all comes in. So for countries, for many companies in China, it's taken more than 5 years to get to that. So we'll see if Indian companies, are they able to achieve from right away or not, if they already leverage some technology partnership with Chinese companies, can they get to this right away or not is a question. We'll need to see how it evolves. But right now, if you see, without PLI, right, so you have a battery cell, you have raw material, conversion cost, there is obviously no profit right now. And assuming obviously a higher PAT and interest cost versus China, now PLI is 20% of sales. Here I've taken PLI as an operating benefit, but actually it is nothing but a capital subsidy. So actually you should reduce it from capital to reduce your capital cost. But there is no operating profit with or without PLI, right? So PLI is only reducing your capital cost. And also clearly PLI is, whichever way you look at it, is not sufficient. So you need some BCD. Now, if you have BCD, so let's say the cell price, which is 45, goes to 52, and then you have all these raw material costs, then you maybe achieve ROC. The challenge is these are imported raw material costs. This is not Indian raw material cost. This is Indian players, like all these chemical companies we're talking about, will not be able to produce all these raw material at this $33 price. This is China, where everybody is bleeding, right? That is the price. After that, you see 33. Let's say if India makes this, we maybe estimate, let's say they make at 50, when you're making LFP, all these different in-house, then you need even more duty support. So it's so basically when I started, I said PLI, you need certain value addition. So let's say at current prices, your battery cell is 45, you're importing LFP and everything and doing it end-to-end. Right, you are making electrodes and all yourself. Your raw material, you're buying from everything. The entire bill of materials, you're buying LFP, electrolyte, everything from China, let's say, hypothetically. Then your raw material cost is 33, and then your value addition will be 30%. Maybe $15 is the value addition divided by battery cell price will be 30%. You need to achieve 60% to be able to get PLI. So then the PLI says the value addition done by the raw material manufacturer will also be counted in your value addition target. So then basically it seems to imply that you have no option but to source raw material from within the country. So, and then when they produce LFP and all, the value addition done by them will also be counted as value addition in the PLI. So in a way, it's indirectly saying you have to buy raw material from within the country, and which is why in Ola's report also, if you see, they mention Neogen Epsilon as the raw material suppliers they're talking to. The challenge is that obviously if they supply to you, they'll supply at this cost, and ultimately the economics for the manufacturers will work out only if they get some duty support. So it's all coming back to duty support. For the raw material manufacturers, they just want, typically when we hear it, they want pricing and contracts. And so it's ultimately BCD might come at the end products manufacturer level. So these are I'm not a chemical analyst, I just cover batteries, but a chemicals analyst put these figures that these are the various companies participating in the entire value chain. As I mentioned, you have cathode, which is you're making LFP powder, your converter basically buying lithium carbonate, iron phosphate and all and making this. Then you have anode in various places in electrolyte, and then copper foil and aluminum foil. We'll see lithium mining. There's talk of obviously lithium reserves in Kashmir, Rajasthan, but how sufficient they are they good quality, how much time it takes to develop, it's going to be possibly not this decade, possibly next decade. Then on the question of pump storage versus battery, there are actually new technologies evolving, and once we reach solar as a critical part in let's say in the entire power generation mix, right now it's renewable is only single digit in the overall power we're generating, or maybe in the charts we showed it's gone up to 10-12%. But let's say when it hits a critical mass inflection point, then there is no option but to look at longer term duration also. And there are new technologies coming up, and this is critical for power, not really for EVs. The longer storage option is what we'll need, and if it becomes viable, that's going to be even bigger inflection point for renewable energy. So these are all different technologies. So pump hydro is there, but pump hydro is already well established. LFP battery is already established. I think the other ones are now in various stages of technology curve, and we'll see how they shape up. There are different types of technology. One is just throwing a rock it's called gravity based, that unlike like pump storage, you are throwing a rock in an underground mine, and then you're lifting that rock, right? So lifting rock up uses energy. So you use solar to lift a rock up, and then you put the rock down, and that moving down rotates a turbine. So there are many compressed air, many new technologies. We'll see how, that was a very basic mechanical one that I talked about, but new chemistry, compressed air, carbon, storage. So this is that chart that we saw, well, actually the country was missing. The middle one is India, then you have Europe and Indonesia. Battery can play, as per target, significant role in meeting that peak power demand. This is at when we look at LCOE, the levelized cost of energy, which is the cost of discharging power from battery. That is dependent, it's all largely two components. One is the capex cost, which is fixed cost, which is the cost of battery plant. As I mentioned, that number is about $120 right now for all in turnkey. And then the other one is the cost of charging. So you're charging battery at solar, let's say 2.5 rupees per unit. There is typically some yield loss, so you use 100 units of power to charge a battery, and at the end you're getting 88 units. So there is a yield loss. Pump storage, that yield loss is about, you inject 100 units to charge battery, and at the end you're getting 77, 78 units. So the levelized cost is the cost, that price at which you will discharge battery, and a price which recovers your charging cost and your capital cost. So that number was obviously 14, $15 rupees also. It was actually 16, 17. It's come down because it's based on current charging cycle of 8,000. Earlier we had 3,000 cycles, so you needed to replace battery pack constantly. So at current 7,000 to 8,000 cycles, and looking at this capex cost and assuming 8.5% interest cost, the cost of discharging power from battery is about 6.5 rupees. As I mentioned, somebody asked a question that, so 6.5, 7, that number for pump storage is going to be about 8 something. Thermal, new plants coming in would be only fixed cost of 3.5, and then variable cost will be anywhere about 2, 2.5, 3, so it's about 6, but also that is dependent on 100% utilization. So if you lower the utilization, it's only meeting power in the evening, then your fixed cost per unit is going to go up. So these are all the equations everybody is trying to solve. I think the big joker in the pack has been battery. It was, nobody was thinking about it, and suddenly last year they dropped so sharply, then now it's become an important component in the entire planning globally. So it has um, various materials, just implications for metals globally. If we reach, let's say, 3,000 gigawatt of production, that will require 6% of overall copper that we're producing right now in the world. And it's not so steel intensive, but yeah, that's it. Question?
Thank you, sir. This was a very insightful presentation. So, sir, my question is, so as you know, sir, right now LFP chemistry is dominant, but this like whole thing is very dynamic, and we don't know. Like I was reading, ki solid state batteries are generate 2.5 times better energy than the LFP ones, and they have a higher density also. So, don't you think this all capex by the Indian players, which are planning to set up end-to-end manufacturing, comes with a lot of risks? And what risk can an analyst and investors track here?
Obviously, that's an evolving situation. We'll see in the current technology that you put up, can you integrate, because if you look at an LFP versus NCM, it's largely very similar. The only difference is cathode, right? So you buy a cathode, whether it is nickel-based cathode or LFP, everything else is the same, largely. So the only risk is for anybody making LFP powder, if NCM takes up, then but you can buy a different raw material. So I think the biggest risk is obviously somebody making raw material. So the further back or upward you go in the value chain, the higher the risk of technology change. When you look at solid state, it's largely solid electrolyte and then but based on our understanding, because it's something that's going to evolve over time, there's a possibility you can do it in the same cell manufacturing setup, right? So you're making electrodes, you're making all of this, you're only buying different, instead of LFP, you're buying something else, instead of solid electrolyte, because you're ultimately not making electrolyte. I think the challenge will be more as you go upward in midstream and all that, somebody making LFP, somebody making electrolyte, can that same player who's making liquid electrolyte make solid electrolyte? There's a possibility there might be adjacencies that somebody has already demonstrated some experience in making liquid electrolyte. Can they actually do it in solid also? So that is obviously where a chemical analyst would be able to better. But generally, based on the discussions we've had with our Chinese counterparts, this is all going to be evolving. So the risk is obviously at the extreme end of lithium manufacturer who's making lithium and nickel. Lithium dies down, nickel takes up or something, then somebody mining lithium is obviously at the most risk and versus NMC. And as you go down, the risk obviously subsides, but it's obviously going to be somewhat evolving situation.
And second question is, I want to touch upon the battery recycling part. So it's it's been a long journey. As you mentioned, the cycles of batteries keep on increasing. But there will be a point where these batteries need to be recycled. So I guess no listed company, except I guess Himadri Specialty Chemicals, I see on their presentation, they were talking about the recycling. So how do you see the battery recycling part? And if unit economics works in battery recycling? And if we discard a lithium battery, on an average, how much lithium we can extract from the battery, the disregarded battery? And if apart from lithium, if we can extract any other metals also. So if it is really profitable for the listed entities if they enter into the recycling part in the future.
There are companies entering lithium recycling. I think the biggest one is Loham. Loham is actually based in Noida or something. That's one of the biggest recyclers out there in the country, largely based in Delhi NCR, and there are others. I think the challenge right now is when you look at recycling, you need a stock of lithium, right? So any recycler, as a country, we're struggling with enough scrap for steel also, that we want green steel, but we're not enough, we don't have, because we've not industrialized. Once you industrialize, so all these EVs and all, first we need to sell EVs, then after 10 years, because in EVs, the concept is total cost of ownership. It's TCO, which is basically not just initial cost, but also after a certain year, the pack needs to be replaced, as you rightly mentioned. So resale value typically drops for EVs. And that is something that companies are trying to figure out how to, maybe at the end of the life, there is more juice left in batteries than what people expect and all. So that is going to determine their resale value. But also on recycling, we don't really, whatever recycling we are seeing is largely from electronics and all, right? A very small percentage of overall market. The TAM is very small right now. That is obviously going to evolve as longer term we have more EVs and that comes back into the system that needs to be recycled. But obviously, honestly, I've not done much work on the entire economics of recycling and what all materials, but it's too small right now for us, at least on the public side, to be able to look at it.
And so last question is, as you mentioned, we are on the similar stage. Like we were on the side of the solar module manufacturing. So we don't have any raw material, we don't have any supply chain. But still, there was a government support which came in the form of BCD or ALMM. So what are the things you mentioned we are getting PLI, but they aren't sufficient to meet the requirements of the cell manufacturers. So what are the other things that an analyst and investor could track, the benefits which could get from the government, and how much BCD you think is sufficient to make the unit economics work for the...
So generally, outside of PLI, at once, so you can see the same learning curve that we've seen in solar module. We started with PLI, then BCD, then ALMM. So instead of ALMM, you may have approved list of cell manufacturers, battery cell manufacturers, approved list of battery chemical manufacturers, LFP, so all, and then BCD. So that will be a function of when we thought of the entire solar module, we didn't think we'll first need BCD, ALMM. That is based on how much time does it take for us to close the gap with China, how much, and that's going to take some time. So that obviously is going to be a learning curve as we see these companies. Right now we have only 1.5 gigawatt, which is not even shipping, and it's not immediate, right? So the domestic market opportunity unlike module and all, it's already played out in a way. This one is slightly in the future we are looking at. But as of now, we can see the same learning curve in cell module. The economics I shared based on if we achieve 85% throughput, largely maybe 10-15% BCD for them to make money using imported raw material. If we have to have domestic raw material, then you need even higher. We showed 20% plus BCD for that. Based on 85% utilization, and these are all numbers that we've taken from global comps and all. We'll see, one of the things is we need to see how India evolves in terms of efficiency, productivity, yield and all. But using those benchmarks, that's the number that we should.
Thank you, sir. Thank you.
Yeah, Satya, hi. One thing which I think your presentation didn't cover was the equipment suppliers for these battery manufacturing. So the analogy would be similar to what we are seeing on module and wafer manufacturing, where China has stopped supplying wafer manufacturing equipment to India. So is there any concentration risk in terms of equipment or lack of equipment availability?
That's always there. Is one company which has already set up ingot wafer in the country, and they're saying we've set it up and we can, before this entire equipment, solar module, solar ingot and wafer I'm talking about, that maybe China has stopped and we have an edge we've already built And so that risk is obviously there. There is multitude of risk. The capital also to be able to tie up lithium, lithium carbonate. China has already built massive reserves and tie-ups with other countries. So that partnership, you're relying on Chinese, Goshen and all till a limit. But when you make cell manufacturing on your own, you need to have tie-ups also. There are two main players in the cap goods side. It's China and Korea. So Korean equipment is typically, which is when it is generally believed that, I think it's mentioned in the report also that Ola may have sourced some from China, but typically the capital cost for buying from China is about 20-30% lower is the rule of thumb or generally believed to be versus buying from Korea. But Korea is there as of now. Obviously, if China stops supplying and the opportunity is so big, can Korea meet? These are all risks to be seen and to be evaluated over time. But as of now, we can only think of Korea largely.
As an alternative. Okay. Second question is, in terms of these battery suppliers, what kind of clawback clauses are generally seen in the contracts if the battery does not perform as expected? There are lower cycles, more degradation, lower round trip efficiency. So an IPP, how can they claw back some of the capital at least from these contracts?
It's a very technical question. Usually, as an IPP, when you bid for projects, you look at the recent tender that came out for battery, very specific. Yesterday, where it is mentioned that you have to, it's the rate of degradation also mentioned 2.5% each year, this much throughput. If you're not able to meet, then you have to replace. So the IPP has all the responsibilities. You're asking me that if the cap goods guy is not able to supply equipment, what are, typically there are various, as you know, tier suppliers of, you have pricing, so you have warranties. So people compromise on the tier to get lower price to compete in tenders, but it obviously comes with compromise on warranties. And also the warranty is the only thing I can think of beyond warranties that gets into a gray area.
And what's the duration of the warranties? 5 years?
That I'm not aware what is the duration of it.
Okay, thanks.
On the source of electricity, I mean, are you considering offshore wind? And there is a lot of discussion going on now on small nuclear molecules also, SMR. So are you considering those as well?
So that is obviously a function. So honestly, 2 years ago, nobody was thinking about battery. Right now, nobody is thinking of solar module reactor. The cost is when we look at, let's say, nuclear plant will be 8 to 10 crore per megawatt, if I'm not mistaken. Wind is 8 crore and all. SMR right now is 40 crore per megawatt. It is beyond imagination as to how expensive it is. There's actually Padma Shri scientist who's advisor to Niti Aayog. They are bullish on SMR also as an opportunity in future. Right now, the economics doesn't favor it, but we'll see how the technology evolves. On offshore, obviously, there is interest. There have been few pockets which have been identified of the cost of the cost is going to be significantly higher. So we are starting with some kind of capital subsidy, VGF, the variable grant funding. We started with some other projects also, even battery storage, we started with VGF. Here also on offshore wind, we are starting with some VGF. The transmission cost is also higher because you need to set up entire transmission offshore to get power. So the cost is definitely higher. The PLF is higher because the density of wind, the wind generation is going to be higher in offshore. The overall delivered cost of electricity without support is also somewhat higher, and it's something that the potential is there. The government identifies all these zones where we can put up offshore. There is certain component in the planning for transmission. When you look at 9 lakh crore transmission that I mentioned, there is a component where government has already planned will have some offshore and all. It's not going to move the needle as much, right? So we're not looking at 50 gigawatt of offshore or SMR. SMR is not even there in planning right now, but offshore is a potential, but will obviously there is no offshore wind right now in the country. As it evolves, we'll see. It's not going to be that significant as of now as we see right now.
Hi. I'm referring to GUVNL's latest BESS tender, in which the BESS tariff fell to as low as 3.8 rupees. Now, apart from this battery packs, the cost of manufacturing coming down, what do you think could be the other drivers which have led to such low tariffs?
There's only one battery pack, battery BESS. There's only, these are GUNL tenders. When you look at, there are two components. Typically, there's only leasing. One part is leasing, where GUNL is, you set up battery cost, and they're able to lease. It's like a rent. They're paying you annual rent. And against that, you set capital cost. So it's only your capital cost and how much you're recovering rent. There is no other thing. Then GUNL will use that battery, charge it, and then discharge power, right? So that entire model is broken down when we look at Gensol, Integrate, all these tenders. When they're tendering with GUNL, it is first part of that stage where GUNL doesn't set it up on its own balance sheet. Somebody comes and sets it up and then provides on leasing. Even pump storage projects now are coming up on leasing model. And then there is an entire end-to-end model where you set it up, you charge, and you discharge power. So if you look at the entire model, there's only two variables. Typically, your capital cost and interest cost, as I mentioned. Interest cost has not really changed. The only thing that has changed over time is, as I mentioned, battery pack coming down in number of cycles. Because if you earlier, let's say 2 years ago when you were entering, you were looking at 3,000-4,000 cycles. The tender is basically for 12 different years. Usually the tender you're talking about is 12 years. That you meet 2 cycles, 2 cycles, and then if there is any degradation or battery needs to be replaced, they just want 2-hour cycle, 2 cycles a day for 12 years, right? So let's say 2 hour, 2 cycles is 4 cycles in a day, 365, 1400 cycles. They just want the throughput GUVNL. If the battery degrades before that, it's the responsibility of the developer to replace. Generally, the battery cycles getting longer means the need for replacement is also reducing, and the pack is also. So only those components which have led to these. The first tender was 10 lakh per megawatt per month by JSW. Now it's gone down to 3.5 something, as you mentioned. It's largely these two components.
A follow-up question. So do you think they are factoring in the interest rates that are going to fall over the horizon and the lower refi rates and higher gearing ratio because of that? As of now, are they factoring that into their models?
That's a question for the developers. Typically, they're very shy about answering all these questions. It's all competitive tenders. But when these bids were won by Gensol, Integrate and all, we were all debating how is this possible at current best prices. And there's a possibility that maybe they were factoring in a reduction in prices. At that time, they were seeing oversupply and prices coming down. There's a possibility it was viable at that prices also, because we were all scratching our head and trying to figure out the first one that came out, the first Integrate slash Gensol, because there have been multiple bids. First one came about 7-8 months ago. I doubt they're building lower interest rate, because these are all PE-backed firms in a way. When you look at Integrate also, they're building their model. They will not compete and take on that risk that you bid at lower and are hoping for interest, and the interest cost doesn't come down, then you're taking that risk. They will not be, in my opinion, taking that risk. If that happens, that'll be an incremental opportunity IRR, but largely based on whatever they're able to procure in the market and then building that in their model at current interest rate and what IRR they will be.
Yeah, another question. So are the lenders for the best projects, are they risk covers as of now and they're charging a premium on that, or is it like in line with what they're charging for the solar and wind projects?
Interest costs we use in our model typically when we talk to these would be somewhat similar. And when we talk to one of these players that we talk about, it's somewhat in line with developers only. The off-taker is GUNL. You getting monthly is the only risk is for you to be able to replace the battery. Do you need to replace or not? They're looking at cycles. But generally the interest cost, in my opinion, based on discussions, obviously these are sensitive discussions to be had with developers. And but it's not too different from what they get for developers. Might be slightly higher, but not much.
Got it. Thank you.
Thank you so much.
Well, thank you, Satyadeep. So you capsuled decades of knowledge in 1 or 2 hours. if I have to give my analogy, personal analogy, मैं about after power sector मैं अंगूठा छाप था, अब मैं अपने signature लिख सकता हूँ, but to be able to understand full sentence, I will have to watch your presentation again and again few times. So thank you very much. I would invite my volunteer colleague Gaurav to present our small token of appreciation. Well, thank you everyone for coming. We end this presentation today.